The S&P breaching that 200-day moving average for the first time since March. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to the closing bell here in the U.S., and it is not too pretty as we try to get to the end of this Friday. The S&P 500 currently off about 0.6%. We are off session lows, so that's a little bit of good news, but of course, looks like we're going to end this week on a down note. Same thing for big tech. You can see the NASDAQ 100 off by about 0.7%. Even though we're starting to see a little bit of relief in the bond market, we'll see if I regret those words. Currently, 10-year yields off by about 6-7 basis points. We got close to 5%. We're a little bit below that right now. And I wanted to highlight gold because gold has had quite a move over the past few weeks, continuing to rally today. Romaine currently up about 0.4%.
Yeah, amalgamate the last 5 days here, and you got a bit of an everything sell-off with almost 400 of the S&P 500 members nursing losses on a weekly basis. The S&P 1500 Regional Banks Index, that's one of the biggest drags that we've seen. This after earnings over the last few days from Washington Federal, Zions, Bank United, and this morning, Regions Financial, all disappointing investors. More signals that the fallout from the SVB crisis this past spring has still yet to fully play out. Regions Financial this morning reporting higher costs for deposits and funding. Net interest margin slipping significantly. Regions right now the worst performer in that banking index today, down the most going back to March of 2020. Meanwhile, GM and Ford looking to close out the week on a high note. General Motors saying it has actually made substantial progress in negotiations with automotive workers who began those rolling strikes back on September 15th. The company saying its latest offer on the table, it includes a $40+ per hour wage for the majority of the workforce. We're still waiting to hear, of course, today from UAW President Shawn Fain. And if you're waiting to hear from Jay Powell and the FOMC members again, you're going to have to cool your heels for just a little bit longer. November 1st, the Fed's quiet period, it begins tomorrow in the run-up to their next policy meeting. A quiet period, Katie, that leaves a decisively bearish financial market to its own devices, at least for the next 11 days.
A lot of time to let that anticipation build. And like Romaine said, you take a look at where the market is standing heading into that blackout period. It's not too great. The S&P 500, with today's downdraft, you can see we actually touched the 200-day moving average. That is your yellow line here. We haven't been there since March. So we'll see whether that acts as support or whether breaking through that level leads to more losses. But a lot of that answer depends on what happens in the Treasury market, specifically when we take a look at long-dated treasuries and we take a look at that in relation to the front end, because it's interesting. You take a look at the 2s10s yield curve right now. We've seen quite a re-steepening. But what's interesting to me is that this is a bear steepening, Romaine. It's not coming from short-end rates going lower. It's from long-end rates going higher. What that means for equity markets, the complexions of that re-steepening remains to be seen. But at this moment, of course, seems to be casting a bearish pall over the equity market.
Breaking news right now, Katie, crossing the Bloomberg terminal. Representative Jim Jordan of Ohio is no longer the Republican nominee to be Speaker of the House. Remember, there was a third floor vote earlier today, which Jim Jordan lost. Then they went behind closed doors, the Republican Party, to assess exactly who would support him. And based on that conference vote, we're now learning that Jim Jordan is no longer the Republican nominee for Speaker of the House. We're going to dive a little bit deeper into that later in the day here. But once again, just a reminder that the House of Representatives here, a bicameral Congress that we have, one of those houses of Congress right now still has no leadership. All right, let's turn back to the markets, I should say, right now, and kick things off to the close here with Catherine Avery, CEO and President of Catherine Avery Investment Management. And Catherine, let's start off here, not with the nonsense going on in Washington or some of the geopolitical issues, but earnings season, which I thought was supposed to be the salve for this market. The idea that if we didn't necessarily get a lot of sort of bright spots out of those 3Q numbers, at the very least, we might get some signals that the earnings trough was in. I know it's still early, but have you been encouraged?
Actually, very encouraged. And Romaine, thank you. And Katie, thank you for having me. I think next week we really get into the thick of it when it comes to earnings. And for the third quarter, we're expecting probably anywhere between flat to slightly positive single digits, year-over-year positive earnings growth. And if you take out the energy numbers, it looks even better for the S&P 500. But I think that's going to give people a lot of encouragement going forward. 2024, we're looking at a 12% year-over-year growth for the S&P 500, and it's only going to get better going into the fourth quarter. I think a lot of stocks are starting to see that the pricing pressures are starting to ease off. We're going to start to see some better profit margins going forward as inflation has started to ease.
What's actually moving this market right now, Catherine? Is the focus really on earnings, or is it still on the Fed and interest rates?
Right now, it's on the Fed and the interest rates. The steepening of the yield curve, which has actually been, it's kind of nice to see, because you want a steeper yield curve. It takes away a lot of those recession fears that we were having before, which is somewhat positive. But right now, it's a lot of the supply that's being rolled off from the Fed's balance sheet that's not being readily absorbed. And look, I look at it this way, if the market does the job of the Fed, then maybe we can sit back and say that the Fed has definitely paused and is ready to sit back and take a wait-and-see attitude.
But Catherine, is that maybe be careful what you wish for a situation? When you think about potentially the bond market doing the work for the Fed, sure, you can look at the rise in yields that we've seen thus far and make that conclusion. But at what point does that turn more hurtful than it has been helpful?
Yeah, I think at some point the market will tell you enough on the rates. And I think the market could probably handle a 5% 10-year, but as we get north of that 5% rate, I think it gets a little tough for certain companies. But, in anything, you have to look at, well, if this is what the market's given us, well, where do we go? And you want to look at towards those companies that are not dependent upon the debt markets to grow their businesses. So something that's quality, cash rich, has a dividend yield where they're returning money back to shareholders.
And talk to us a little bit more about what companies that excludes. When you think about, a sector, an industry level, what are the companies that maybe you would exclude from your overweight positions right now?
I would be a little bit careful of the financials. They're going to have some headwinds with the rates going up. I mean, that's usually not normal. Usually when the interest rates go up, their net interest margins expand. But now we're at a time where it's going to hurt their capital requirements. Consumer is another place that would really be leery, anything consumer related. Whereas consumers, if they start to take on more debt, that's going to impact their ability to spend more.
When we get to this idea here, Catherine, the idea that the market is waiting for, I guess, a little bit more of a baseline, and knowing that not only are corporate fundamentals relatively healthy, but the economy has sort of reached some sort of threshold that people can be comfortable with here. Do you think that that also means that we have to get comfortable with a 5% or whatever that neutral rate ends up being with the Fed, that is more or less here to stay, barring a recession that would cause them to cut rates?
Yeah. Well, Romaine, 5% is really not abnormal. It was the 0% interest rates that we had after the great financial crisis that was abnormal. So a lot of this is really just getting back to a normalcy into the yield curve. And so I think that that the market has the ability to absorb that, has the ability to grow in that phase. And again, focus on, as we said, the areas to avoid, but how about the areas to focus on? Let's follow that money. Where is the money going? Where is capital moving into? And if you take a look at the fiscal policy, it's all about infrastructure and onshoring. So looking at companies that are industrial, bringing manufacturing back here in the U.S., material companies, again, looking at companies that are involved in artificial intelligence, technology companies that may not have the higher valuations, but those that are the staple technology companies that are involved in the ecosystem of artificial intelligence, that have that strong cash flow, returning capital back to investors, and have those lower valuations. So that's where we're seeing a lot of money being deployed. And then lastly, the energy sector. We're depleting our supplies of oil here in the U.S. and strategic reserves. And we have this disruption over in the Middle East. OPEC has cut production. We're seeing that the commodity price is now over $90 for crude. It's probably that we're going to see the base of that commodity price in the $80 to $100 range, as opposed to a $60 to $80 range. So that's going to be good for these companies.
All right, Catherine, great stuff. Going to have to leave it there. Catherine Avery, CEO and President over at Catherine Avery Investment Management. Decades of experience there. Our thanks to her as we kick you off to the close. Coming up here, a closer look at President Biden's appeal for billions of dollars in aid for Israel and Ukraine.
Plus, with mortgage rates rising, we'll take a closer look at the pressure on the U.S. housing market and what could happen next.
And where are you comfortable in this market? Piper Sandler saying Microsoft is its highest conviction large cap stock right now, at least for the rest of the year. We're going to talk to the analyst making that call. Some great conversations coming up right here on The Close. This is Bloomberg. We do want to get back to that breaking news. Jim Jordan, the representative from the state of Ohio, is no longer the Republican Party's nominee to be Speaker of the House of Representatives. There had been 3 formal ballots cast on the floor of the House to elect Jim Jordan as Speaker. He failed in all 3 of those tries here. And then the GOP members went behind closed doors, held a secret ballot to see just how much support he had in his own party, and he failed that vote. He is no longer the nominee, and we are now waiting to find out what's coming up next. A lot, of course, is going on in Washington, and late last night we'd heard from the president about the conflict in Israel. President Biden last night made a direct appeal to the American people to support funding the war efforts in Israel as well as the war effort in Ukraine.
Hamas and Putin represent different threats, but they share this in common. They both want to completely annihilate a neighboring democracy, completely annihilate it. Tonight, there are innocent people all over the world who hope because of us, who believe in a better life because of us, who are desperate not to be forgotten by us, and are waiting for us. But time is of the essence.
President Biden in the Oval Office last night addressing the American people. Kim Wallace joining us right now here on Bloomberg Markets to Close, Senior Managing Director over at 22V Research. And Kim, it's pretty rare, at least for this president, to make an Oval Office address. I believe this is only the second that he's made since he's been in office. Who exactly do you think he was speaking to last night? The American people or to a different audience?
Oh, I think his first and primary audience was the American people. It was very much, Romaine, a pitch for value-based policymaking for the U.S. stature in the world. I thought the president did very well in justifying the request that he subsequently sent up to Congress to fund wars against Ukraine and the Middle East war that's blown up, the latest one. It's $106 billion he's requested from Congress. And of course, your lead-in about the House Republican Conference puts a spotlight on U.S. domestic politics and geopolitics in a way that's quite unusual.
Some of the criticism from the Republican Party was swift, as we expect it to be. But one particular nugget of, a narrative that I saw come out of that criticism was this idea as to why the president would combine this appeal for Israeli aid with also Ukraine aid. And we should point out there was also money in that proposal that would go to border security down south.
Well, that's part policy and part strategy. The strategic part, I would imagine, is that as politics around Ukraine heat up, along with the 2024 election, it's unmistakable that those two things are linked. The president and his team probably decided that they have a shot to get a bulk of what Ukraine might need from the U.S. for the next 3 or 4 quarters, and they decided to go for it.
And when you think about the other component of that, of course, the potential border funding, border security measures, I mean, is that enough to push this over the line and really secure this package? Because it's quite a lot of money we're talking about here.
Katie, we'll find out how much the $2 billion almost $13.5 billion for border affects the voting in the House and the Senate. My sense is that Senate Majority Leader Schumer has said that the Senate will act with haste. It's very likely that attempts to split this request in parts will come. I don't think they'll be successful in the Senate. And in terms of the House will have to confront the reality of a president leading on an issue, sending a request that the Senate sent over, very likely in strong bipartisan vote, and then decide what the House given its condition over the last 3 or 4 weeks, really has scope, political space to confront.
Yeah, and of course, the House is dealing with plenty of idiosyncratic issues right now, if you will. Let's talk a little bit about the American people. And to follow up on Romaine's question about who the president was addressing, when you think about American support for funding these efforts overseas, what do past examples tell you?
Well, the past examples tell you a couple of things. One is that over time, Americans grow wary of foreign wars. But before that, and I don't think the country has changed significantly on this score in the last 20 years, there is a call to arms. If a president in a commander-in-chief mode makes the case to the American people, and he's made the case in Israel, he's made the case in Ukraine for almost 2 years now, very likely he still has a little oomph left to push this over the line. Again, I think the question comes, who or what stops it on Capitol Hill? I would argue that the House of Representatives right now is probably not as formidable a obstacle as it might have been 6 months ago.
All right, Kim, we got to leave it there. Really appreciate your time on this Friday. That is Kim Wallace of 22V Research. Now let's turn back to the latest on the race for a House Speaker, because Representative Jim Jordan, of course, losing the GOP Speaker nomination after a new conference vote. Let's bring in Bloomberg's Kelly Lines in Washington for the latest. And Kelly, how much of a surprise was this? Because last I heard from Jim Jordan, it seemed like he planned on going through with another vote.
Yeah, and he did go through with another vote in that third round earlier today, Katie, in which he bled even more support. 25 members of the Republican conference voted for someone else other than Jim Jordan. So once again, he lost. That is when they went back into this conference meeting and by secret ballot decided that Jim Jordan should no longer be the speaker nominee of the conference. And he lost by a pretty wide margin, 112 to 86 votes. So the question is going to be where the conference goes from here. What members are saying coming out is that they're going home for the weekend. They'll be coming back Monday evening to hold a new candidate forum, decide who next should be the speaker designate. Already we have had a number of members tossing their hats into the ring, including Oklahoma Congressman Kevin Hern, Michigan Congressman Jack Bergman, and if you remember, Georgia Congressman Austin Scott, who had really suddenly thrown his hat into the ring against Jim Jordan initially about a week ago. He has said he'll be running for speaker again. It's anyone's guess, though, if any of them can get to 217 votes.
Well, that's a big question I have here as to sort of what ends up being, I guess, the backup measure, if you will. I know there was a lot of talk about just trying to expand the powers of the pro tem speaker, Patrick McHenry, though that seemed to sit well with Jordan and a few others. And even some of the Democrats say they weren't necessarily on board with that. I mean, what options do we have? I mean, it's been more than 2 weeks now, Kaylee, since we've had a speaker at the House, and we still have a big budget deal that is still unresolved, that needs to be resolved in less than a month.
You're absolutely right, Romaine. This is day 17 without a speaker, and it's only going to get longer considering we at least won't have one until Monday, if not later. And that November 17th deadline to fund the U.S. government is looming quite large, as is the White House's request, as you were just discussing, for $100 billion in aid to Israel, Ukraine, and some other efforts. So it is going to be really difficult to get anything done in the House until there is a speaker. That is just the fact of the matter. Patrick McHenry thinks his power is limited to overseeing the election of a speaker, and he has told members that he will not be doing anything on the floor unless they give him that explicit power through a resolution like what was being discussed in the Republican conference yesterday. But that was shot down in conference. It did not have adequate support. Even Jim Jordan was saying, yes, extend McHenry's powers for a certain period of time. It'll allow me to whip more votes. And they did not go for that. It does seem like Hakeem Jeffries, the Democratic leader today, was open to the idea of Democrats working with Republicans to try to get something done in a bipartisan manner. The thing is, a lot of Republicans don't want to give that kind of power to the Democrats. So where we go from here on that issue remain also unclear.
Yeah, I mean, that's sort of compromise and, running the government, something that got the last speaker booted from his job. Kelly Lines,
exactly.
Down in Washington. You can check her out every day on Balance of Power. And Katie, there's been so much reporting about kind of what was going on behind closed doors and some of the tactics that Jordan had taken, which seemed to involve curse words and browbeating people, which I'm told apparently didn't work. I don't know. I mean, who knows? I mean, everyone has different methods of getting what they want. But in all seriousness, this gets to the idea here is that this is ultimately a job about compromise. And not just compromise with the other party, but compromise even within your party and finding middle ground. Kevin McCarthy clearly couldn't do that. Jim Jordan clearly couldn't do that. I don't know who else is left in this slate of candidates that's going to be able to do this.
That's what I'm curious to see. And of course, they'll come back next week. Hopefully over the weekend, they identify what candidate could actually get the votes to get this over the line.
Oh, that's cute. You think they're going to work over the weekend? This is Congress we're talking about.
I'm a little bit optimistic. I mean, if I were in the seat, I would
You're a glass
think about
half full kind of person, aren't you?
You know, especially on a Friday. But stay tuned, because coming up, Amex delivers record profit. More on what the CEO says is fueling that growth coming up next. This is The Close on Bloomberg.
American Express out with results earlier today. Third quarter revenue and profit did actually beat some key metrics there, and actually hitting record levels on a couple other key metrics as the company continued to attract new cardholders who are willing to pay some of those high annual fees for, I guess, what it says are a premium product. Our very own Caroline Hyde spoke with the CEO about the outlook. That CEO said Q3 is a continuation of another strong Q2. We're really confident as we head into 2024 that our plans are working out exactly as we thought they would. Of course, that quote sort of doesn't hit the idea, too, that growth has actually slowed pretty significantly as well. So they did sort of meet expectations, but we should point out that bar had been lowered.
Yeah, there's a lot of nuances here because, of course, growth slowed, especially if you take a look at small business spending. But then you take a look at revenue, and they beat handily there. We're talking about $15.4 billion in revenue. I think the analyst expectation was around $13.6 billion. But I want to talk about generational differences, because I loved this quote from the CEO. Of course, he said that Millennial and Gen Z now have more spending in the quarter than our baby boomers. We're going to be with them through their life's journeys. The lifetime value of these cardholders gives us a lot of confidence in the future. I was pretty, I mean, you're combining two generations, of course, but still, I was pretty surprised by that.
Yeah, you're combining two generations, unfortunate two generations I'm not actually a part of, sadly. That ship has sailed for me here. Are they going to be willing to pay $600-700 a year for a platinum card or whatever the fee is on it?
That's a bold call, that we're going to be with them throughout their entire
entire life. Well, you know, they have to get the lounge situation fixed at the airports, because last time I tried to get in with lounges, it was like a mess. And it was like, what am I paying for? But then the other perks and the cash back, that's gone down as well. Do you think Steve watches this show? I got complaints.
This is The Close.
This is the countdown to the close, almost 2:30 here in New York as we round out the week in financial markets. Stocks remain on the back foot. Treasuries a mixed bag on the day. Commodity space, well, a little bit of a mixed bag there as well. Abigail Doolittle is here with our commodities close. Abigail.
It certainly is, Romaine. On the day, we have the Bloomberg Commodity Index basically flat, and beneath the surface, we have some bigger moves here. Gold off of its highs, but still up 0.5%. That Haven bid. Silver also higher on a Haven bid, up about 2%. To the other hand, on the other side, we have wheat down 1.6% after a couple of up days, and copper, Dr. Copper, telling the global economy today not doing so well, down 1.25%. Now, it's interesting though, because we do have the Bloomberg Commodity Index up for a second week, and this of course has everything or a lot to do with oil. If we take a look at oil over the last 11 days or so, we are going to see a very big climb, and this of course came after a big fall, so we have this volatility in oil. But over the last 11 days, Romaine, up 8.2%. It had been, WTI crude had been back above 90. The charts, the technical charts, still suggesting that there could be a big directional move higher or lower from here. It's going to be really interesting to see what way that might happen, if it does in fact happen.
All right, Abigail Doolittle there, a nice roundup of what's going on in the commodity space. Let's turn back, well, to the housing market. Bloomberg opinion columnist Connor Sen is out with a new piece titled, quote, "The U.S. housing market is now completely broken." I agree with that. For the first time since the Federal Reserve started raising interest rates, every part of the housing market is now poised to worsen. Connor joins us right now to talk a little bit more about this. And Connor, I was looking at some of that data we got earlier this week with existing home sales and, of course, mortgage rates continuing to go up here. I mean, this is a housing market that almost doesn't exist right now. I mean, unless you really have a gun to your head and you're forced to buy or sell, that's really the only transaction that's taking place right now.
Yeah, existing home sales are basically lower than they were at the depths of the financial crisis. Mortgage purchase applications are at a 26-year low. We have the multifamily market, which was actually doing okay last year, is now softening because rents have flattened out and apartment builders can't get financing. And then the home builders, which have done okay this year because they've been buying down people's mortgage rates to say 5.5%, are finding it a lot challenging when conforming rates are 8 instead of 7. So even that, I think, is going to pull back in the months ahead.
Yeah, and Connor, that's what I found interesting. I mean, among the many interesting things in your column, the fact that home builders have really hit that inflection point, because for a while, that's been the story of the year, really, this tailwind that home builders have felt. But it sounds like, of course, that's fading now.
Right. And when mortgage rates were 7 and, they could buy down to 5.5 and their margins were still pretty good. So it was kind of like a Goldilocks scenario for them because resale inventories were so low. They were the only game in town. And now we're actually seeing resale inventory pick up a little bit. And again, it's just a lot more tough on your margins to buy down from 8 to 5.5 than it was from 7. And I think they'll probably have to do some cuts now and then just cut production to account for that.
I'm curious if there are any real broader economic ramifications here, Connor, because when you go back to the big housing crisis that we had in, what was that, 06, 07, 08, and there, I mean, that was a real collapse that we saw in the market. This isn't really a collapse. It's just kind of a, I don't know, a pause or whatever you call it. And I'm wondering if the fact that there aren't a lot of transactions, does that have real economic consequences relative to a market where you're seeing a material decline in values?
It's really just about holding back. We'd have higher inflation and higher growth if we had sort of a normal functioning housing market. So it's kind of interesting that at a time when people are freaked out about interest rates and 10-year yields are approaching 5%, we now have a housing market that's going to be in the doldrums for another quarter or two, I'd say at least, which should mean sort of a ceiling on economic growth in the next couple of quarters and maybe be some relief to bondholders after a really tough stretch.
So, Connor, when we talk about this broken housing market, what I've been wondering is when we finally see mortgage rates start to come down, I mean, how much pent-up demand could be waiting on the other side of that?
Yeah, I think that's a reason to be sort of not very concerned about recession because there is so much pent-up demand. Right now, we have about 4 million existing home sales. A normal market, like even we had in 2016, is probably closer to 5.5. So that's like a 30% increase in existing home sales we could have. There's probably pent-up moves from people who maybe didn't get a chance to move during the pandemic and then feel like they missed their moment when mortgage rates backed up. Just sort of movers, realtors, lenders, all kinds of people who aren't getting the incomes they normally get when we have a normal housing market.
All right, Connor, it's a great piece. Really appreciate your time. Our thanks to Bloomberg opinion columnist Connor Sen. And Romaine, I mean, I think the point about home builders in particular is really interesting because you take a look at the sector overall, it's still up 18% year to date, so outperforming the broader market, but started to cool a little bit in the recent weeks.
Yeah, and I mean, but it gets to the idea too as to what's the balance, right? Because this wouldn't be so bad, meaning on the home ownership side, if you had a rental market that was a little bit more favorable to people. But we know those rents are still elevated in most major markets, and even the secondary markets, we've seen those rents elevated. So you've kind of got nowhere to go.
Yeah, no one's happy.
No one's happy unless you're actually in a home with a 3% mortgage. Then you're sitting pretty, assuming you don't have to move.
But even if you're sitting there and assuming you do want to move or you would like to move, no one wants to buy your house right now, and you don't want to give up that mortgage. So
yeah,
I don't know.
Have you actually tried to look for a house as of late at all?
Recently, no. Just for fun. I mean, I still look on Street Easy. I have the app downloaded, but then you get down to the monthly payments section, and in a lot of cases, you just be better off renting. Yeah,
you know what's really great with those little calculator functions now?
Yeah.
Is do that monthly calculation using whatever the current average rate is, 7.75, 8%, and then do it again with like that 3% rate that you would have gotten, just barely a year ago.
That hurts my feelings.
I mean, I hope you have a box of Kleenex next to you because it will make you cry. Believe me, I've shed a few tears late at night like that.
Yeah, well, don't do that this weekend then. I hope you have better weekend plans, but stay tuned.
I have nothing to do, Katie.
Stay tuned. Still ahead, Piper Sandler says that Microsoft is the hottest large cap around this year. We're going to get all into that next. This is The Close on Bloomberg.
All right, let's get a view from the sell side with our top calls to look at some of the big movers on the back of analyst recommendations. And we're going to start with Dycom Industries. This is a sells engineering, design, planning services for a lot of infrastructure. Raymond James upgrading the stock to strong buy. This after Dycom's biggest customer, AT&T, reported strong third-quarter earnings and made some interesting comments about CapEx spending. The analyst says Dycom is positioned to be one of the biggest beneficiaries from companies opting for fiber optic upgrade, shares up 4% on the day. Next up, Knight-Swift, the trucking company, upgraded to neutral over at JP Morgan after its third quarter earnings beat. The analyst says Knight-Swift is making progress with its acquisition of U.S. Express despite the difficult state of the truckload market. Knight-Swift having one of its best days in about 3 years, an 11% gain. And finally, Union Pacific, an upgrade to buy over at Deutsche Bank. The analyst says pay close attention to U.S. rail volumes, seeing encouraging trends since the company's new CEO took over in August, and that could generate outperformance for Union Pacific relative to the broader market and relative to its Canadian rail rivals. Union Pacific shares up fractionally on the day, and those are some of our top calls. We do want to stay in the sell side space here and focus in on Microsoft. Piper Sandler naming Microsoft as the top mega cap pick to own for the rest of the year. This is for its advances in generative AI and growth potential for the next 3 to 5 years. He joins us for more is Brent Bracelin. He's the co-head of technology research. He has an overweight rating and a $400 price target on Microsoft. And Brent, let's start off exactly why Microsoft relative to some of those other mega cap names. And we know so much attention, at least when it comes to AI, has been put on NVIDIA, which we should point out is outperforming Microsoft this year by like 5 to 1. Why Microsoft?
Sure. Yeah, good question. I think at the end of the day, as we think about the tech group as a whole, AI has been a big driver. But ultimately, Microsoft is really on the eve of a major Microsoft Copilot launch here in November. The reality is we kind of need proof points of success for Microsoft to justify buying more GPUs. So this is going to be a major product launch that really justifies investment in AI. If Microsoft can't justify that investment, we're doubtful that any software company will work into year end. So we're quite bullish. Early feedback on Copilot has been positive. That's really the catalyst that you're playing for here. You also have some easy compares. Remember the December quarter of last year in their non-cloud business. This is still a $100 billion business. Yeah. It was actually down 13% year over year. So with an easier compare, we actually like the setup where Microsoft could actually have an improvement in their growth profile, one of the few in software, going into year end in that December quarter.
I am curious, and we should point out we get Microsoft earnings next week, I believe next Wednesday or so. I am curious here, Brent, about kind of the diversity of its business relative to some of the other mega cap peers. Does that work to its advantage, or does that maybe hamstring them a little bit in terms of efficiency?
Listen, you could argue that PCs have been a drag on Microsoft for 2 years. If you look at the last 2 quarters, you're actually seeing sequential improvement in PCs. So I think the diversity of the platform, they're now adding a very big game developer platform, gaming platform, Activision onto the platform as well. That's just going to only further insulate earnings power, we think, over the long run, and really help this business, which is a very large business, continue to kind of grow, potentially even at a sustainable 9, 10, possibly 11% kind of growth profile over the long term, and really drive profitability meaningfully higher.
So, Brent, a lot of reasons to like Microsoft here, but I guess the pushback would be that shares are already up, 37% or so this year, that the good news is already priced in. How would you respond?
Yeah, listen, our view is pretty simple. The reality is Microsoft has to and needs to show that these AI investments are going to drive incremental revenue. And we're on the eve of that proof point with the launch of M365 Copilot. Yes, if you look at the large cap software groups that we cover, on average, those stocks are up 30%. But ultimately, if you think and believe in this AI market, you can't essentially fund additional AI investments in GPUs unless these software companies start to generate incremental revenue. So ultimately, it's going to hinge on proof points that come out of November and December on the magnitude of folks that are interested in Copilot. If you think about the installed base, 160 million E3, E5 subscribers out there, every 5 million of those that add Copilot could add about $1.5 billion of incremental revenue to Microsoft. So yes, part of the AI optimism is baked into all of these software names. Microsoft, though, will be the very first one to show monetization, we think, starting here in that November, December timeframe. And so we think that will be a catalyst.
Well, Brent, to that point that, of course, Microsoft has the first mover advantage here, how wide is that gap? Because also to your point, I mean, there's a lot of other software names that are putting a lot of money into AI right now.
I think the debate really in software is going to be who can charge for the incremental features when a lot of functionality is going to be at parity. Large language models are democratized, meaning every application is going to have a conversational intelligence within the next year or two. And so which of the companies are actually going to be in a position to monetize that feature? That's a debate. Right now, you're seeing companies like Workday and HubSpot, they're adding AI features, in some cases for free. So we think Microsoft, with their outsized position, over 80% market share in productivity tools, is really going to be in a better position to monetize and drive value from AI.
All right, Brent, great to catch up with you and great insights. Brent Bracelin over at Piper Sandler, a conviction on Microsoft. And just a correction, I said they were reporting on Wednesday of next week. That's actually on Tuesday of next week, along with Alphabet. Some breaking news crossing the wire right now. This on the United Auto Workers strike. We're learning that the UAW is said to have asked GM, Ford, and Stellantis for a 25% pay raise. I believe that part we did know, but Stellantis is said to have matched GM and Ford's offer for a 23% pay raise to UAW. There's been some interesting, though somewhat conflicting commentary coming out of the United Auto Workers as well as some of the automakers. But overall, it does appear that they are making some progress. The latest news here is that Stellantis is said to match GM and Ford's 23% raise offer to UAW. The auto workers were asking for 25%. All right. A lot more coming up here on the program. We're going to talk with the Vice President of the European Commission as U.S. and EU leaders gather for a summit at the White House. That's coming up next here on The Close on Bloomberg.
Well, President Biden meeting today with European leaders at the White House. It's the second summit between the U.S. and the EU since Biden took office. Now, the summit was scheduled to focus mostly on trade relations, but geopolitics in the Middle East have injected new urgency into the gathering. Joining us now from Washington is Věra Jourová, Vice President of the European Commission, and it's great to have you with us. And let's start there. What is the main topic of conversation going to be at this summit? Of course, there's trade relations, but talk to us about how the Israel-Hamas war is weighing into this.
Yeah, you were right by saying that geopolitics must have been dominant in this discussion. Indeed, we discussed about the situation in Israel, and it was a reassuring discussion. We agreed on the need to support Israel in its defense against terror. Also, we agreed on the need to support those who need humanitarian aid. And also, we agreed that we have to intensify our diplomatic outreach in the region, because the escalation or regionalization of the conflict would not be good for anyone. So this was the dominant topic: Israel, fight against terror, but also we devoted a lot of time to Ukraine and the need to continue the support for Ukraine, be it through weapons, be it through finance. And we also had a chance to reassure Mr. President Biden that the EU is and will be continuing supporting Ukraine in their fight against the aggressor.
Well, give us a little bit more details on what those conversations around Ukraine support sounded like, because obviously this war has lasted a lot longer than a lot of the initial projections, even on the Russian side, of course. So looking into the future, what will that support continue to look like, especially now that you have other geopolitical concerns enter the conversation as well?
Yeah, the support of Ukraine from the side of the EU is very stable. We are very united. We decided to invest additional 50 billion euro for the following 4 years. It doesn't cover the money for reconstruction. It's another story. But we need to support Ukraine in also the basic functions of the state. So we are sending 1.5 billion euro every month so that Ukraine can continue to function as the state organization and as also the country which is reforming their justice system, their fight against corruption, the institutions which fight against organized crime and so on. So we are supporting Ukraine in many ways, and we will continue to do so. And this was the opportunity today to reassure Mr. President that this is the track which the EU will continue to take.
Věra, I am curious about some of the other issues that the U.S. and EU have been trying to sort of find some compromise on, particularly when it comes to the oversight and even potential regulation of technology companies and some of these new sort of technological areas that still don't have formal guardrails out there. Was any progress made on that today?
Yes, we did not have much time to discuss these matters, but I will soon have a thorough discussion with Gina Raimondo during the Technology and Trade Council, hopefully in mid-December. Well, the EU and the US, I think, have the same interest that the technologies have to serve the people, that there must be safety of AI, there must be at the same time sufficient financing for innovations because we are competing with China in this field. And so we will continue this discussion. I am always happy to share with our US partners information about how the regulation is continuing to be established in the EU because, as you know, we have now the final stretch of negotiations of AI Act, which is a pioneering piece of legislation. And also we have enforced now newly the Digital Services Act, which is the set of rules which should increase the responsibility of the platforms.
Is there enough agreement within the EU member nations? So the 27 nations here, when you're there negotiating, trying to sort of find common ground with the US, are you doing so with the explicit understanding that the 27 member states are also on board with that?
Well, when it comes to technologies and the regulations and also the international work, we have a very strong mandate from our 27 member states. The Commission is doing the work in full understanding and cooperation with our member states. So we are representing the EU in G7 talks. We are now ahead of agreement on the code of conduct for generative AI, also with the United States. And here, when it comes to technologies, we have quite strong unity with all 27 member states.
All right. We really appreciate you taking time for us, Věra. Věra Jourová there. She's Vice President of the European Commission for Values and Transparency in Washington, D.C., here in the U.S. this week for negotiations with her U.S. counterparts here. We got about 5 minutes here until we get to the top of the hour, Katie Greifeld. That means 1 hour left here in the week for trading here, and it has been yet another choppy week.
I have some stats for you.
Okay.
So the S&P 500, it's down 2% this week.
Okay.
It broke 2 straight gains, weekly gains for the S&P 500, erased October's gains.
Yeah.
If October is a 3rd straight month of losses, we haven't seen that since 2020.
Wow. Yeah. And it gets to this idea here. I mean, what exactly does the market want? Because early in the year, the narrative was that they were looking for either Fed cuts or at least a signal that cuts were coming. That's off the table right now. So what exactly do they want that will give them more confidence to bid things up?
Maybe we'll find out next week when we actually get some of the big, meaty earnings from those big tech giants. Maybe that will provide relief or maybe another reason to sell. But it'll be interesting interesting to actually hear from the companies themselves, of course, as we enter into that Fed blackout period.
Of course, also a big week this week for oil and a big week for treasuries. In fact, on the 10-year benchmark, while it is down on the day, it's still setting up for what's going to be the biggest increase on a percentage point basis that we've seen in at least a couple of years. Romaine Bostick and Katie Greifeld sitting side by side by Ariano as we count you down to the close. This is Bloomberg. Almost 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostick.
And I'm Katie Greifeld.
We talk about a market here that has been on the back foot all day long. And of course, Katie, headed for another week. I thought it was interesting today. You saw the S&P 500 for the first time since March actually retest that 200-day moving average. As of right now, is basically sitting right on that line.
Yeah, it feels like we're spiraling a little bit here. Of course, we're still sitting on double-digit gains for the year, but that stat feels a little stale when you think about really the backdrop since July. I mean, it's been a really interesting couple of months, and now we're heading into a really interesting juncture, of course, when we have big tech kicking off next week and no Fed speak.
And no Fed speak. I don't know. What are we going to do here? I do want to point out, though, I mean, you take a look at WTI crude. It is pulling back just a little bit, though. We should point out it is still going to be higher here for a second straight week, as, of course, what's going on in the Middle East seems to drive that number. And take a look at the CSI 300, only down 0.6% here on the day. But actually, Chinese stocks as a group, Katie, have now erased all of their gains from that reopening rally that effectively kicked off about a year ago, late last year. All of that now has been gone as a lot of the optimism is completely faded here. And if you just flip up the board real quick, too, I just want to show you the VIX
I want to look at it, yeah.
Do you pay attention to the VIX curve?
Not as much as I should.
Yeah, the chart doesn't really, it's kind of hard to see on that chart there, but basically what we're looking at is backwardation between that front month contract and that second month contract. Basically, you're paying more for protection in the shorter term than you are in the longer term. Typically, that's not a good sign.
It means things are scary closer. Yeah, so definitely something to keep an eye on. But let's talk about some of the individual movers today, because there is a lot of single stock action going on, mostly related to earnings. I want to start with Knight Swift because it's having a great day, up 11%. That's after basically beating expectations. You had third quarter adjusted EPS coming in above expectations, as well did total revenue. It lifted all of its peers as well, pretty much. You had JP Morgan upgrade the stock. You had Morgan Stanley reinstate the stock as a top pick. So some interesting news coming out of the trucking sector.
Yeah, and I mean, I guess that's encouraging, particularly when you saw the news out of JB Hunt. I mean, obviously these aren't two apples to apples, but the idea that they were seeing a little bit more softness there, but this seems to be an encouraging spot here going forward. You were taking a look at some of the regional banks as well, right?
Yeah, so that was the good news. Look at some bad news. Regions Financial having a terrible day, down about 13% at the moment. It was down as much as 16%, basically warning about further declines in net interest income, higher rates continuing to take a toll there. So as you can see, the stock is falling, as you would expect. And I did want to talk about Apple really quickly, not too much in the way of fundamental news, but this would be a sixth straight day of losses. We haven't seen that streak, that length of a streak since January 2022. Yeah. We do have to wait until November for earnings for Apple, but interesting to see this prolonged fall.
Yeah, interesting too. And I mean, I thought we were supposed to get a boost out of the new releases with the iPhone Titanium or whatever they released here. And I guess, I don't know, we'll get the numbers, I guess, in a couple of weeks, but at least for right now, not giving a boost to the stock. 1 hour away from the closing bell, our cross-platform coverage, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Massar and Tim Stenovic. Welcome to our audiences across our Bloomberg platforms, television, radio, originals, and our partnership for those folks streaming on YouTube. An interesting day here in the market, Carol Massar. Yeah. We got a lot of earnings this week here, including earlier this morning out of American Express, which I think would give somewhat of a read about consumer spending and a little bit of a mixed bag as to what we learned.
Yeah, absolutely. It gives you a little bit of a reading, certainly into what customers are doing. Certainly, one would say on the higher end, right? But I also love what it says about business customers, small business and others. And what we are seeing is that growth in spending by that group of customers, business customers, they're slowing down. And I always think that's a great indicator potentially of maybe what's to come.
How about Gen Z, though?
Gen Z's doing well.
They're doing okay.
They're spending money. The company CEO, Steve Squeri, said that spending was strongest in the U.S. customer segment. Millennial and Gen Z consumers continue to be the fastest growing portion of our card member base. I don't know if they're shelling out $695 a year for that platinum card quite yet, but maybe in a few years. And Amex did really well when it came to actually getting consumers to pay up more for these cards.
I would just like to point out, Tim, that Katie and I had this conversation a little bit earlier.
Yeah.
And at one point,
it went really well.
She mistook me for a baby boomer.
I don't think I did that. I was just saying.
Carol, don't you?
Has she ever heard of Gen X? I'm just wondering.
No, she forgot about Gen X. She was like, there's baby boomers and there's millennials.
Gen X is the most, I will say this, Gen X is the most underrated generation.
Thank you, Tim.
Yeah.
And I'm not just saying that because, we're talking to Romaine here right now.
It sounds like it. But.
Katie, we'll go watch some Reality Bites, a classic Gen X movie.
Okay.
You can learn a little bit about the 90s.
Okay. Yeah. I mean, I was born then, but I wasn't really conscious for a lot of it.
Remove her from the set.
Well, don't make me leave yet because I want to talk to you about this other story. I'm dying to talk about it. It's titled "Ozempic for Kids?" ? Firms test weight loss shots for 6-year-olds. This is really fascinating.
6-year-olds.
Eli Lilly and Company, it's planning to test diabetes drugs for patients 6 and up. You also have Novo Nordisk testing a older and less powerful version of drugs such as Ozempic and Wegovy. A lot of this depends on people familiar with the situation. But I mean, we talk about these drugs all the time, and it feels like we're really testing the limits here.
6-year-olds.
Yeah.
Okay.
Yeah.
I mean, can you think about, I don't know if you guys remember Carol, giving a shot to a 6-year-old, like a flu shot or something. This has to be once monthly.
Do parents do that themselves?
No, parents don't do it, but they have to take their kids and deal with the aftermath of it.
Oh,
they would probably figure out a different formulation.
I mean, they are working on pills.
Yeah.
But without trivializing this, I mean, obesity is a huge issue in the U.S. with kids. And I just, it would be nice in the U.S. if we address the situation too in sort of a different way rather than through this, like maybe addressing it through nutrition, addressing it through lifestyle changes and those sorts of things.
Yeah, I mean, I know that these drugs serve a real purpose for a certain segment of the population, so I don't want to minimize that. But we also know that there is a huge sort of, elective sort of side to this, and when you start bringing in underage children, it kind of raises the question: are there other alternatives to just putting them on drugs at the start of their life that they're going to have to be on until, the end?
Well, exactly. I think you feel like you can have an internal debate with yourself, like how long will these individuals have to be on these drugs if it is forever, and what are the repercussions? At the same time, obesity creates a whole other swath of health problems, and that can be a big problem as well. All right, we got to run. All right, guys, we'll be back in less than an hour's time. Our cross-platform coverage, radio, TV, YouTube, and, of course, Bloomberg Originals. We're going to count you down, wrap up the Friday trade and the week overall. We'll see you at 4 p.m. Wall Street time.
We continue our coverage here on The Close, counting you down to those bells with just about 53 minutes to go. Blackrock's Kate Mor sees a tough road ahead for stocks, writing in her latest note that while the next few months will likely be bumpy for equity returns, we believe the combination of tepid positioning and solid fundamentals could propel stocks higher into year-end. And she adds that we continue to rotate in favor of longer-term thematic winners, and that includes tech, healthcare, and consumer, as well as high-quality growth. Pleased to say that Kate Mor is joining us right now. She's head of thematic strategy over at Blackrock's global allocation team. All right, Kate, I want to start off first with that broader idea here that maybe the way that this market is positioned right now is kind of that coiled spring, and that we maybe could start to see some material upside, I guess, once whoever, I don't know, we won't name him, gets out of the way and lets the market do its thing.
Yeah, I mean, Romaine, I think the point is there is a lot of people who are waiting for a positive catalyst. In order for the coiled spring to spring, as it were, we're going to need to see, I think, a couple different buckets of good news. Number one, I think you need to see good news on the fundamental side. Perhaps we'll talk about earnings later. But I think confirmation from people that the worst is over for us in terms of the earnings recession that the U.S. large cap space has experienced over the last 3 quarters. I think the second bucket, of course, is around policy. That is very well known that we want more of an all clear when it comes to policy adjustments in 2024, even if we have one more rate hike ahead of us in 2023. And then I think we need an overall cooling in terms of some of these global tensions, whether it's geopolitics or I think greater belief perhaps in the Chinese growth story that will support a lot of the global multinationals, both in terms of their earnings and activity. So there's a lot of things people are looking at to catalyze taking more risk and taking some of that cash yielding over 5% off the sidelines.
I am curious. I'm glad you brought up China because this kind of seems like the elephant in the room that we stopped talking about a long time ago. And I know it's debatable as to just how much their economic issues actually affect us in a material way here. But do you think we should be paying more attention to some of their struggles?
I think it's really important to look at China as a more insular economy, much as we've looked at India in the past, frankly. There are many specific drivers to China, whether it's policy or specific consumption or specific regulation. But it is important for global demand of a whole bunch of resources. For example, they have leading companies in parts of the energy transition, electric vehicles and batteries. And it's important to watch what's going on both on the market as well as on the economic side. Will a Chinese slowdown in 2024 kill the overall global economy? I'm not so sure. I think the U.S. is much more important at this point. But in terms of overall demand and in terms of earnings streams for a bunch of global multinationals, China still matters a lot.
I want to switch gears here and talk about fixed income because I'm looking through your notes and this line really caught my eye. Within fixed income, we plan to opportunistically close our underweight in duration. Talk us through that. And what does opportunistically mean here?
Yeah, look, we're not convinced that we've seen the highest rate that we're going to see, for example, on the 10-year. And while I work on a multi-asset fund and I'm an asset allocator, I'm not exclusively a fixed income portfolio manager or strategist. What I would suggest is when we look at the overall fixed income opportunity set, we see more kind of in the short end. We've been underweight duration. We're obviously taking advantage of cash rates at this point. And we're just not convinced at this point that adding to longer duration assets is the right call. In fact, I kind of like some of the barbell between the short end and the belly of the curve, as well as the equity space.
Yeah, and that's what I wanted to do, sort of draw the line between what's going on in the fixed income market, in the treasury curve, and what opportunities that's necessarily creating in the equity space. How are you thinking about that relationship?
Yeah, I mean, Katie, this has been one of the biggest debates is like how much has higher rates really impacted the corporate sector? And the truth of the matter is for the long.
Oh, it appears that we lost Kate Mor for the time being, which is a bit of a bummer because it feels like that's really the big conversation in markets right now, just not how high yields can go. But what does that mean for equities?
Yeah, absolutely. And I mean, look, is the idea, though, too, that investors, and I think, Katie, I think we have Kate Mor back if you want to finish that thought.
Yeah. My thought was basically that the higher rate environment has not had as much of an impact on the large and mega cap space as some would have expected. Some of that is because we know these companies have termed out their debt. Some of that is because they have a lower proportion of floating rate. But a lot of it is because these companies have gotten disciplined over the last 10 years and have really been financing a lot of their CapEx, a lot of their hiring, a lot of their expansion with free cash instead of debt. So there's been a mentality change in addition to an overall structure of debt change across the large cap space. I think that's going to be an okay environment for 2024. And you've seen the market punish small caps and companies that are highly levered and are reliant on floating rate debt.
Kate, I think that's so interesting because the conversation around tech, especially a couple of years ago, is that these are the companies that are going to be more vulnerable in a higher interest rate environment because of those long duration cash flows. But I feel like we've really had to have a real rethink of that logic for that reason that you mentioned, that these aren't companies that are necessarily having to tap the debt market with these higher rates right now.
Yeah, that's absolutely right. And I think we need to look at companies today and really take a good look at each of their own balance sheets, each of their own financing, each of their own cash flow prospects, instead of saying kind of with a knee-jerk reaction, higher policy rates are a bad thing for higher multiple of growth companies. It is a really kind of more of a mixed bag. Similarly, we've seen some of the value type companies, things that are trading at a discount to the market, stay cheap for longer periods of time because they haven't done the work on their balance sheets or their debt structure, and don't have the prospects for growth in a more moderate economic growth environment.
Kate, great to catch up with you. Have a wonderful weekend. Kate Mor there, head of thematic strategy over at Blackrock's global allocation team. As we count you down to the close, some breaking news right now. Shares of Okta, the cybersecurity company, plunging 12% just in the last few minutes. We're learning based on a report coming out of Krebs Security saying that there had actually been some sort of a hack involving Okta where hackers had access some keys that Okta uses to protect the identities of some of his customers. Those shares have plunged. Remember, this is a company, Katie, that specializes in cybersecurity. We're now learning again from a third-party source here, Krebs Security, that there are hackers who apparently have breached some of the key credential keys that Okta uses to protect the identities of some of its clients.
And you can see Okta shares down a quick 12%. We'll continue to follow that story as it develops. And coming up, we'll also get the latest on the auto workers strike as union leader Shawn Fain prepares to give an update on the negotiations and whether it will expand the strike.
And one of the biggest decliners today, solar stocks. A warning shot for the solar industry as a revenue drop at Solar Edge causes a record plunge in its shares. We'll talk about what exactly happened.
And the bidding is on for a rare bottle of whiskey that could fetch more than $1 million. We're going to find out just what exactly makes this bottle
Gen
so
Z can't afford
special.
that.
Apparently. All that and more coming up. This is The Close on Bloomberg.
Kind of get down to the close with less than 42 minutes to go. You look at the green on the screen behind me, an anomaly to be sure. You look at the red on the screen to my left here, and you get a better sense of what's happening in the market. A market down about 1% across the board, led by big declines in big tech. NASDAQ 100 down more than 1%, with Tesla adding to yesterday's declines, down 3% here on the day. Even the upswing that we saw in Netflix today, basically not getting any juice there, unchanged on the day, and some disappointing data and numbers that came out of Hewlett-Packard, pushing that stock down almost 7%. The big insights that we had earlier in the week from the pharma companies and the biotechs, that's gone as well here on this Friday. And the regional banks as well as the big banks also providing a bit of a disappointment for this market as we head to another week of declines overall. Of course, a lot of this is being driven by what we've seen in the yield space. And on a weekly basis, yields are higher, though we should point out, at least here on this Friday, they have moved a little bit lower here off some of the highest levels we've seen going back to 2007 or 2006, depending on which part of the curve you choose to apply. Let's bring Abigail Doolittle into this conversation, as we do every day at this time, for our Options Insight segment. And Abigail, I was actually taking a look at volumes. We're up, 15, 20% over where we would normally be over the last 20 days or so here. Options expiration, I'm told, is driving part of that.
Absolutely. At the open, it was 1,400% above, really telling you that there was a lot of movement early on as some of these securities were expiring or being rolled forward. And with everything going on, options expiration to some degree has been left in the dust. But let's examine it now with Kevin Kelly, CEO of Kelly ETFs, and I can't think of a better person to talk about options expiration with. And Kevin, I remember triple witching back in 2020, and that, of course, was in the dark days of the pandemic when the stock market was crashing. And you suggested to me a day or two ahead of that time that it could actually clear the decks for the bulls to come in, and that actually did happen. What a rally out of those late March lows. Is this a similar situation? Is this a buy the dip opportunity?
Well, it feels like a similar situation where we may have gotten short-term toppy on the VIX. And the reason I say that is because if you look at the VIX curve, if you go out 3 months, the 3 months VIX is barely higher than where spot VIX is right now. And we're also entering into earnings season, which tends to mute volatility because you could have certain sectors go up, certain sectors go down. So during earnings season, volatility gets muted. What that means is we're sort of in this no man's land where it's a great opportunity to add to positions you like or wanted to get into. It's not necessarily a time to start going out and buying the broad-based market here, but volatility seems like it's gotten toppy in the short term.
Yeah, and to your point, taking a look at that VIX curve right now, a little bit of backwardation in terms of spot VIX to November and December, but then 3 months out, not that much higher. So folks not really pricing all that much in. On the other hand, Kevin, we have the Fed at hand, geopolitical tensions, earnings season, which to your point can create some dispersion, although I'd argue some of those indexes have been starting to peak up off of the lows. If you were to be concerned, given the fact that the S&P 500 wrestling with that 200-day moving average, the Russell 2000 maybe leading the path well below it, what does concern you in options land?
Well, what concerns me in options land is that, we've got like commodities. If you look at it, people are actually going in and there's 2.2 times 5 the amount of calls versus puts in gold even, right? So people are starting going to options and starting to put bets on those flight to safeties, even though they haven't hit those or broken out to all-time highs. We saw, with the Ukraine war, 2050 was a high. We saw regional banking crisis, 2050 was a high. We're still not there on gold.
And I know that your idea is to put on a covered call on gold, one way to take a look at the options in there, and we'll hope to dive more into that the next time we have you on here, Kevin. Kevin Kelly, CEO of Kelly ETFs, thanks for joining us for Options Insight today. And from New York, this is Bloomberg.
Well, a bottle of what's been dubbed the most sought-after Scotch whiskey is set to go up for auction next month. Sotheby's in London will auction off a 96-year-old bottle of single malt whiskey from distiller Macallan. And the estimated price, Romaine, take a listen, it's $1.4 million. I cannot imagine how this tastes.
Well, I would assume whoever buys this isn't actually going to drink it because I would
it
would be, it would be nice, I guess, maybe like, when you're on your final days on your deathbed and you're like, you know what, might as well just live it up here with this $1.5 million bottle.
I cannot imagine a better display of wealth than to actually buy the bottle, but then to also drink it.
Yeah, I mean, this is a collector's item, and look, I would never pay anything like this for the record, but I do know people who are maybe not necessarily not necessarily $1.5 million, but they collect stuff like this, and it is kind of like bragging rights, and this is very rare. I mean, we're talking about something that was produced a century ago, initially produced, aged for 60 years here, and it's been batting around the hands of various owners over the years. So it is certainly a trophy, and you know what, Katie Greifeld?
Tell me.
I think it is an appreciable asset.
Wow, no kidding.
So yeah, it sounds like a lot of money. I don't know if it's recession-proof, but I assume at someday you're going to find another sucker to pawn it off on.
Well, I did want to quickly bring you this detail. This bottle going up for sale, the first to undergone reconditioning. That means they replaced the cork, they applied new glues to the corners of the bottle labels. Isn't that charming?
I don't like the sound of that. Okay, I don't know.
Brand new label. I don't know if you would
necessarily. I'm $99.95 for that, but not a penny more.
Yeah. In any case, much more coming up. This is The Close on Bloomberg.
This is the countdown to the close. Just about 30 minutes until we get to the end of the trading day. Katie Greifeld and the week.
It's an ugly end to an ugly week. The S&P 500 hanging out close to session lows right now, down about 1% at the moment. And it is a big, broad sell-off. That circle, it's almost completely red. You take a look at what's leading it there. Down at the bottom, you have tech and you have energy, both off by about 1.5%. Usually, these have been the leaders to the upside, not so much today. You go up towards the top. Again, all in the red right now. Real estate's, consumer staples, those are your best of a bad bunch, Romaine.
Yeah, almost 80% 30% of the S&P in the red. All 7 of the Magnificent 7 also in the red as well. Apple down 1% on the day, setting up for another week of decline. 6th straight day that we've seen Apple on the back foot, a streak of a daily losing streak that we haven't seen in quite some time. Keep an eye on the solar stocks as well. Solar Edge came out with earnings. It was a big miss and a huge disappointment, really showing not only a lack of a lot of softness in the market here, but the idea that the backlog and the order momentum going forward could also be a big disappointment into 2024. Enphase and some of its competitors getting dragged down as well. Those are actually among the biggest percent decliners in the S&P today. Meanwhile, some of the big percent gainers on the day, who would have thought? AT&T, actually one of the relative big gainers on a daily and a weekly basis here, and a lot of that had to do with some of its capital spending plans and the need for a refresh of some of the 5G infrastructure. Marathon Oil, which had been higher on the day, moving lower by about 2% here on the day, Katie.
Let's get over to one of the biggest stories of the day, of the week, maybe of the month, and we'll see for how much longer, because at the top of the hour, UAW President Shawn Fain will give an update on the union's progress with automakers. And this is as Stellantis is said to have matched GM and Ford's offer of a 23% raise. Let's bring in Bloomberg reporter Gabrielle Coppola for more. And let's see, we have about 28 minutes to go until Shawn Fain takes the stage. What are we expecting to hear?
Well, you know, what we're learning through our sources is not necessarily what's going to be reflected in President Fain's speech. I think, you know, last Friday he said we're kind of ripping up the script in terms of when we're going to call strikes. You know, they had been kind of waiting till Friday to see progress and then announcing some kind of escalation. I do think that we have seen significant progress this week. As you said, Stellantis is now matching the wage demand that Ford had originally agreed to of 23%, and GM has as well. So that is certainly progress. So you might think that, you know, okay, talks are going well. We're not going to see an escalation. I guess that's what I would lean to. But I also don't feel like I can rule it out, because I think the UAW's strategy doesn't always, you know, it's always a response to what happens at the bargaining table, yes, but you know, we've also reported that now that the automakers are agreeing to 23%, they now want 25% wage increase. So I'm just not ruling out a strike. I feel like I don't know for sure what's going to happen.
I am curious, though, here. I mean, we're talking obviously about some of the pay packages that are being put on the table. One of the other, of course, negotiating points was actually what's going to happen with some of these EV and battery plants going forward, how they're going to be staffed and how folks are going to be paid. What do we know about the progress that was made on those negotiations?
Well, it seems like the UAW and Ford are still stuck talking about the battery plants. We don't have the details, just that we know that's really an outstanding issue with Ford and the UAW is the battery plant talks. And then I think with GM, you know, yes, you know, President Fain was very jubilant last week in announcing that they had gotten some language in the agreement to cover the battery plants, but we don't really know the details on that. So I have a feeling that, or not just a feeling, my sense from our reporting is that there's a lot of details that have not been worked out, and there's still a lot of friction on wages. You know, just because a battery plant is going to be part of a master contract, that doesn't mean the auto companies are going to agree to pay the same wage scale that they pay in an assembly plant. So I think there's a lot of friction there still.
There was a great story on the Bloomberg terminal earlier today that really kind of focused in on just some of the issues with regards to inflation, how it's eating away at maybe some of the potential gains that these auto workers do get. And we've had some anecdotal evidence and quotations from folks on the picket lines. I mean, what is the general sentiment among the folks on the ground, not the leadership, but the actual striking workers? How do they feel about a strike now that, at least on a rolling basis, is more than a month old?
I think, and talking to some of my colleagues who've been out on the picket line as recently as this week, and I was at an event here in Detroit yesterday, people want job security. They want the wage gain. They want better retirement. And I think, the EV battery plants, that's job security. That's real. But in terms of, where we are right now, I don't want to speak for the members in terms of what they're going to be willing to ratify because, there's diversity of opinions there. But I feel like a lot of people are like, this is looking pretty good. Like, I think that's what we've heard from a lot of the members, is like, hey, this offer is getting to look pretty good,
But even still, I mean, you had Stellantis announce 100 more layoffs at Toledo this week. Of course, that adds about over 1,500 employees that are now on temporary layoff across their facilities in 3 states. So it'll be interesting to see if that support continues. But I want to talk a little bit more about the costs to these automakers, because also coming out of Stellantis, of course, they canceled plans for one of their auto shows. They were citing the costs of that strike. I mean, at this point now, what, a month or so in, what side is looking like can outlast the other here?
Well, I mean, I think, we've seen GM, I think GM for sure, and I think maybe, I want to misspeak. I know GM for sure have gone out to the debt markets and borrowed money to stick this out for the long haul. I think also some GM vehicles are pretty tight on inventory. I think some of their pickup trucks, their mid-sized pickup trucks have pretty tight inventory, so that could pinch them. But in terms of, I think the car companies can withstand this. No doubt it's going to be a hit. It's hurting them, and it's costing them money. I mean, GM said earlier this month about $200 million. That's what the cost of the strike has been so far. But we're not seeing their sales completely choked off because of this. Across the board, in the industry, inventories have been recovering. And then the UAW still says their strike fund is in pretty good shape. And I think that's part of, I think that's a credit to the savviness of their strategy. They didn't just go and shut down everything and knock out everybody and have to pay strike for everybody. They've been very selective in these kind of strategic targets, where they're, hitting the company so that it hurts, but they're not putting the entire membership out of work and having to pay them. They're doing it in a way that's smart to kind of preserve the strike fund. So I still think they're okay, too.
Well, we'll hear from the man himself, Shawn Fain, in just over 20 minutes. Bloomberg reporter Gabrielle Coppola, thank you so much. Now, coming up on the close, Okta hacked, sending shares sharply lower. It's our stock of the hour coming up next. This is The Close on Bloomberg.
Time now for our stock of the hour. Taking a look right now at shares of cybersecurity firm Okta. At one point on the day, they were down about 14%, with most of those losses just coming in the last couple of hours. This on the back of a report that we learned here that a threat actor had managed to view files uploaded by certain Okta customers who were recently involved in support cases. Okta has confirmed this breach right now. Let's get some insights out of Mandeep Singh, who covers the tech space for us here at Bloomberg Intelligence. And obviously the irony here is that a cybersecurity company effectively getting a cybersecurity breach. But give us a sense, Mandeep, as to what we know about this hack.
Yeah, look, I think their support system, which really involves multiple customers' data, that seems to have been breached. And in this case, obviously, they have confirmed. And there could be a connection with, the MGM and the casino attacks, which also involved Okta a few weeks back. Yeah. And at that time, it was mentioned that, probably it was related to somebody getting unauthorized access, but yeah. Okta systems didn't get breached. So clearly, I think there is that connection that could be made.
Well, I'm glad you went there because, of course, that's, I think, the thought that came into a lot of people's minds here. I mean, Okta and its peers are effectively the gatekeepers for a lot of companies out there, or at least, I guess, the guardians, if you will, here. So if you're able to breach one of their systems, it could potentially give you access to quite a few different types of companies and the customer data here. When we talk about how you analyze these companies here, how much of their own security do you have to take into account?
Yeah, look, I think for any security company, getting breached is the worst type of thing that could happen. And in this case, Okta's role is to, enable single sign-on to all these difference that companies deploy, whether it's on the cloud or on-premise. And once that identity gets stolen, it pretty much gives you free access to, an enterprise environment, and which is why this is critical. Almost the center of gravity when you think about, getting that pass where you can access multiple systems because it's all single sign-on enabled. So clearly, I think it is a big deal if their systems did get compromised, but they are saying it's their support system, not their production environment. And the fact that, hackers got access to real customers' data I think it definitely is disconcerting to hear.
Well, looking forward, even if this specific breach is taken care of and resolved, what's the reputational blow from something like this?
Absolutely. And look, I think gross retentions for some of these cloud companies are close to 98, 99%. That means they don't lose customers and they keep, upselling them newer products after every year. And when something like this happens, it will result in churn and, the reputational damage is obviously there. But there's a lot that needs to be gleaned here from, how the hackers use the data and what got compromised. So we don't know all the details yet, but the fact that they confirmed the breach, that to me is a big deal right now.
And you take a look at Okta shares right now, currently off about 11%. And it's not just Okta, it's really dragging down the whole space. You take a look at Snowflake, you take a look at CrowdStrike. And when you think about the sector as a whole, does something like this at Okta put the entire space on notice?
Well, so there is that trend towards zero security, which all these cybersecurity companies are trying to address, that even if one of their systems got breached, zero security will make sure that you basically implement security at every step. And that trend was already in effect even before we learned about this breach. And I think more and more you're going to see that pivot towards zero security, because you never know which of your systems get compromised, even if it happens to be a cybersecurity system.
All right, Mandeep Singh here, a closer look at Okta, the cybersecurity company, confirming that there had been a breach of some of its systems there. The shares taking it on the chin right now as we get closer to these closing bells. Katie Greifeld, stocks right now at session lows. We started off the day talking about an S&P 500 and a 200-day moving average. The S&P below that 200-day moving average. And
at least you're getting a little bit of cushion, a little bit of relief in the bond market. You can see 10-year yields about 6-7 basis points lower, but it's a little comfort after the big sell-off that we've seen, but still a little bit of a trend reversal today.
It's an interesting setup for next week, of course, with the Fed going dark and something like 160 plus S&P 5 companies set to report earnings.
A lot to look forward to. I'm psyched.
All right, Lauren Goodwin going to be joining us in just a second as we move closer to these closing bells here. A lot to talk about as we wrap up the day and the week. Romaine Bostick and Katie Greifeld. This is The Close on Bloomberg. This is the countdown to the close. Romaine Bostick here. Joining me right now, she does every day at this time, is Scarlet Fu to help us count down to those closing bells and take us to the bell and beyond. And Scarlet, we thought we would maybe end the week on a high note, but no, not right now. You're looking at stocks pretty much across the board at session lows.
Right, and the S&P 500 falling below that 200-day moving average, that long-term trend line. I guess nobody wants to be long before the weekend. You don't know what's going to happen with what's happening in the Middle East. So stocks are lower. Oil was up. It had gone to 90 and then it turned around. Still trying to figure out and understand why. Gold is higher as well. There is some relief in the bond market, but not enough to make up for yesterday's sell-off. Yeah, I mean, some of the swings that we saw in yields this week still relatively unprecedented, at least in terms of like the last couple of years. Yeah,
I mean, so
8, 9, 10, 12 basis point move in the 10-year yield is normal now.
Yeah, and now you have a Fed that has to shut its mouth, I think, by Saturday, right, by the end of the day tomorrow, and not actually speak until spoken to by Jay Powell on November 1st. So I have no idea what we're going to talk about. We should point out there's like 160 S&P 500 companies that are going to report earnings, so that might actually keep us busy. We are busy right now, of course, with about 9 minutes until these closing bells. Lauren Goodwin joining us right now, live on set, New York Life Investments economist and portfolio strategist. And Lauren, what exactly are we going to talk about next week? I mean, and I say that with this some degree of sincerity because, of course, you know, everyone is focusing on what rates are doing and obviously how that all links to the Fed and the economy here. But now we have an earnings season taking place here that at least is trying to steal some attention away from that.
Well, here's the bad news for you, Romaine. It's going to be a difficult job next week because there is so much uncertainty in the economy that we are seeing a market that has no clear macroeconomic narrative. I expect that's going to continue to be the same thing. Now, that uncertainty gives us a couple of interesting things to think about as investors. The first, I think it makes it much more likely that we don't see a Fed hike in November and actually reduces the likelihood of a hike in December, something very different from what I thought just a couple of weeks ago. And the second is that if we continue to have a market that's fluctuating between narratives, then macro's not going to drive your asset allocation either.
Yeah. Well, I am curious about that. Bloomberg Economics, they kind of updated their financial forecast, and there's a new survey that Bloomberg Bloomberg did of economists on their recession expectations, which have gone down, and their GDP growth expectations for 2024, and those have gone up.
Well, that's not really what the bond market is telling us, right? We've been walking this tightrope between an economy that's frankly quite resilient and the reality that the Fed's long and variable lags are catching up with that resilience. And I see the backup in bond yields, at least in part, as the market catching up with this narrative, starting to tip over into the side of we're getting more concerned.
So I guess what drives everything right now is bond yields. The 10-year yield moving, like we're saying, 8, 9, 10, 11 basis points. That's a normal day these days. And there's a lot of questions over what's been driving up bond yields. And Jay Powell kind of addressed it in terms of talking about term premium, which is really a difficult thing to quantify, right? Because different models will spit out different values. Why do you think it's important that Powell is talking about it so much and focusing on it as a reason for driving yields higher rather than talking about inflation expectations or growth expectations?
Well, you've identified the three reasons why yield can move higher: growth expectations, inflation expectations, and the term premium, which is essentially supply and demand issues. And Chair Powell focusing on those supply and demand issues is really important for a couple of reasons. The first is that if it were inflation moving higher, expectations moving higher, or growth, then the Fed would likely have to hike more. And so that tells us something about why they're saying we may be able to pause here. The second reason it's important is that when you are looking at the term premium causing 10-year yields to move higher, that's a sign that yields are likely to continue to be volatile. We can't expect yields to stay in any given range for any amount of time. So as an investor, that means that the institutional call for adding duration, to me, is a bit too premature.
It's a bit too premature, so you don't want to do that across credit either? I mean, do you want to just stay away from duration, period?
We're taking a neutral position in duration, considering that in corporate credit, we see short duration as the right way to go. But there are other aspects of credit where we see moving out further in the curve as being better rewarded. The municipal bond curve is one of those where inversion is not so much a part of the story. And so that barbell, when you put the two together, is a neutral credit duration position.
I am curious when we talk about this idea of positioning around the markets and the idea that a lot of the surveys that we've seen, fund manager surveys, have showed increasing allocations to cash and basically short-term fixed income. And I am curious as to whether we've sort of reached, I guess, a breaking point to that. I mean, I understand you can still make a decent yield there, but at some point there are mandates and there are hurdle rates that are a lot higher than 5 or 6% that you might get in short-term money markets.
That's right. And this is a question I thought a lot about this early in the year. Like, when is really the right time to move away from cash? Now, of course, if you're trying to keep up with inflation and taxes, the time might have been a long time ago, to your point. But when we look at historical experience, even if you're just trying to time the Fed as an investor, we find that actually getting in about 2 months before the end of a Fed hiking cycle is the most profitable move historically, even relative to timing the Fed exactly perfectly. And so if you expect that the Fed may be done or that the market will be realizing the Fed is close to done over the next couple of months, then now would be the time to be moving back slowly into longer, more corporate bonds.
So just to reiterate, though, your view or your folks over at New York Life, the Fed is done? Is that your view?
If you had asked me this 2 weeks ago, Romaine, I would have said that the market is severely underpricing the risk of another rate hike later this year. Now I think it's about a toss-up.
Okay.
In September projections, the 12 out of the 19 FOMC members said that they expected one more rate hike, and that was assuming that data evolved the way that they expected. And since then, data's been stronger than their projections expected. And so you would think that actually the risk of another rate hike was meaningful. Yeah. What we've seen, of course, with the bump up in bond yields is the Fed being a little bit concerned that they want to take some of that risk of tightening and slowing the economy off the table. And so again, about a wash.
So we started by saying that next week will all be about earnings. And I'm curious to get your take on third quarter earnings so far. We definitely see the impact of higher oil prices. Do you read companies as being too cautious or perhaps optimistic given the economic outlook when it comes to oil prices and their impact?
So far, what we're learning from earnings is about what we already knew about the third quarter, which is that economic activity was pretty resilient, but starting to fray on the margins, especially for companies that would be most impacted by lower end consumers, and especially the industrial sectors where we've seen that slowdown be a little bit more pronounced. But a couple of things have happened in the meantime. We've also had earnings expectations moving lower, and so we see a reasonable beat for the average company to be manageable, and so we're not expecting actually a bullish or bearish signal from earnings, just steady as she goes. And one of the reasons why that's so important for investors is if we don't have a macroeconomic narrative, then quality underneath the surface of those earnings is particularly important.
Lauren, great to catch up with you. Have a wonderful weekend. Lauren Goodwin there, New York Life Investments, helping us count you down to the closing bells here. Just about 2 minutes until we get to those bells with stocks at session lows to round out the day and the week. Our full market coverage coming up right here as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet Fu. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with our friends Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms here on a Friday afternoon with more than 80% of the S&P 500 in the red. Carol Massar and broader markets right now hitting session lows.
Yeah, absolutely. Going into a Friday, risk-off trade in a big way. I don't know if you guys have been watching some of the solar companies too. SolarEdge reporting that really took a hit today. And if I look at the Invesco Solar ETF, it's down about 6.5% today. It's down about 12% in the past 3 days. So this sector has definitely been under a lot of pressure as of late, Tim.
Yeah, concern about higher rates impacting potential solar buyers. And, you know, they have to pay more, Scarlet, for installing those solar panels. And inventories are piling up because people just aren't doing it.
Although you could make an argument that maybe renewable energy looks a little bit more attractive if oil prices do stay higher longer term. Of course, that's a big question mark, given that I would have thought with the Middle East tensions, oil prices would be higher. They did get to 90, but now they've backed off.
Yeah, and we should look at wire to wire, though. We talk about the volatility that we saw in the energy space this week. That shows you the jitters. Similar story when we talk about what we saw in the Treasury space. And, of course, here on this day, the VIX, while it is lower on the day, we should point out it's at 21 and change right now, which may not seem high, but relative to the last year or so, where most people thought it should be a lot higher, that is elevated, to be sure.
You know, we've got this trade, right? We're going into a weekend, and I feel like there's just so many questions out there, certainly the Middle East and the geopolitical tensions, you know, worried about a speaker. I mean, there's just this worry list, Romaine, that just, I think, maybe is scaring investors at this point.
If you want a bright spot, Carol Massar, Dow Transport's in the green. A big part of that is because of a big jump that you're seeing in some of the trucking companies and railroad companies on the back of those earnings that we got out of CSX and Knight Swift. All right, let's go through the numbers here on this Friday afternoon. All the major indices save the Dow Transports in the red on the day. The Dow Jones Industrial Average lower by about 0.9% here on the day, and that's going to be good for about a 1.6% decline on a weekly basis. The S&P down more than 1% on the day, down more than 2% on the week, while the NASDAQ is going to close out the day down about 1.5% on the day and 3% on the week. The Russell 2000 not left out of the action, also sliding here by more than 1% on the day and more than 2% here on a weekly basis. And just real quick, Carol, I just should point out here, the S&P 500 did indeed close below that 200-day moving average for the first time since March.
Yeah, the technicians definitely noticing that. Do want to mention a headline crossing the U.S. fiscal year budget gap widening 23% to $1.7 trillion. That on revenue drop, right? We think about the money coming in or not coming in and what that does, Scarlet, to the budget gap. What I will say, though, S&P 500, Scarlet, more than 432 names to the downside today, 69 to the upside, 2 unchanged. So risk off in a big way.
Risk off in a big way, and that's reflected in the 24 industry groups in the S&P. I was monitoring this all day, and for a while you had at least 3 or 4 groups in the green. That has now shrunk to just 2. Telecoms and food, beverage, and tobacco, so your classic defensive sectors, and they're barely higher, right? Gains of at least 0.25%, 1/10 of 1% for food, beverage, and tobacco. On the flip side, autos, that's Tesla, banks, and of course that's Regions Financial, and software and services all down at least 1.8% on the day.
All right, so let me get to some of the gainers. It was kind of a tough task today, and it's kind of random, if you will. First off, I'm going to start with AT&T. At its highs today, was up about 4%, finishing the day with about an 0.8% gain. Scotiabank upgrading the company to sector outperform from sector perform. That seems sector outperform from sector perform. Those are like minor tweaks, I got to say. Citing its free cash flow.
Still green is green, Carol. Green is green on a daily today.
I just always am amazed with these ratings. Anyway, this is the analyst citing his free cash flow following Thursday's quarterly results. The stock's up about 8%, maybe a little bit less than that in the last couple of days, but it's been on a tear since the company reported yesterday. And that third quarter free cash flow was a big beat, $5.2 billion versus an estimate of $4.6 billion. So definitely impressing the street. Jazz Pharmaceuticals, it's a specialty pharma company. It's about an $8.5 billion market cap, rallying in today's session. Bloomberg reporting the company's exploring some strategic options, including a possible sale. This is from those in the know. That stock up 4% at its highs, finished the day, though, still with a gain of more than 1% in today's session. And then Bowl, for those of you who like to bowl, Romaine, you like to bowl?
Bolero, yeah.
Bolero, up 2.6%, was up more than 10.5%, around 10.5% at its highs today. It's
timeless, Carol Mass, right?
Who doesn't like to bowl?
No.
It's the bowling shirts you like, right? Who doesn't like a bowling shirt?
Anyway. Have you ever bowled, Carol?
You know, what do you think? Of course I've bowled. Everybody's bowled.
Okay, I didn't know.
All right, well, the owner and operator
of kind of, fancy. So.
Bowling centers agreeing to a $433 million sale leaseback with Vici Properties for 38 bowling centers. So anyway, got investors' attention. This stock, though, is down about 16% year to date. 69% of the float is shorted, though.
All right, well, no shortage.
Bowl. I even wear bowling shoes.
We'll do group bowling. How's that? It just should be fun. I want to take a look at some of the stocks that moved lower today. No shortage of those. Starting with SolarEdge Technologies, falling by 27.27%. Shares plunged as much as 36.5% today after the company warned that third quarter revenue will be well below its guidance. It cited, quote, substantial cancellations and delayed orders. Talked about this a few minutes ago. Those higher rates are affecting the willingness of consumers to actually pay for solar to be installed. We saw other solar stocks take a hit. Enphase Energy, rooftop solar installers like Sunrun, SunPower, Sunnova Energy also taking a hit today. Regions Financial, it turns out the challenges to regional banks are not completely behind them. Shares falling today by more than 12%. It did slump as much as 16% earlier in the session after warning that it expects further declines in net interest income due to higher rates. You start to see a pattern here, guys, continue to take a toll on the bank. We should note that the results for the most recent quarter included a one-time charge of $53 million tied to check fraud. This is on top of an $82 million operational loss linked to a different fraudulent check scheme last quarter. And finally, shares of Okta falling late in the session as much as 14%, though closing at 11.6% lower this afternoon. This after the security research news site Krebs on Security said that hackers stole access tokens from the company. A few minutes later, Okta did confirm in a blog post on its website that, quote, our adversarial activity had occurred and said threat actor managed to view files uploaded by certain Okta customers who were recently involved in support cases.
Interesting. A little bit of a relief from the Treasury sell-off here on this Friday afternoon, with yields across the curve shifting lower here as at the close here, 8 basis points lower on the 10-year yield for the day. But we should point out on a weekly basis, those yields are up about 29 to 30 basis points from where they were last Friday here. So the biggest weekly gain that we've seen on a percentage point basis for the 10-year, at least going back to April of last year, of 2022. Just to be clear. Yeah, and this is big. And remember, we were flirting with 5% earlier here. And this idea that, again, is not just about whether yields are going up or yields are going down, but it's about the movement. It's about that volatility that is really spooking a lot of people, not just, of course, in the bond market, as you know, Carol, but, of course, that feeds over into equity investors and their sentiment as well.
Yeah. You know, I saw something that Cameron Kreis wrote in our MLive blog, which was really interesting, which is one way that people buy treasuries, of course, retail investors in particular, is through TLT, the ETF that tracks longer dated treasuries. And shares outstanding, which is a proxy for demand, has climbed more than 300% since early 2022. The ETF performance in that same period, just on a price basis, has fallen about 40% in the same period. So even though the price has gone down, the demand has gone up.
I will say just to that, we were having this conversation off air yesterday, but this idea too of also pay attention to the total return funds, which actually are doing better than the price fund. So it'll be interesting to see whether investors, obviously sophisticated investors know that, but the retail hoard, whether they can figure that out on their own.
All right, so Fed commentary, does it go black tomorrow or go?
Yeah, after Saturday.
After Saturday.
That's it, Carol. No more.
No more. All right. So that calms down a little bit, and we get a ton of earnings next week. So I am curious, when you've got the likes of Microsoft, Alphabet, Meta, Amazon, Visa, Coca-Cola, UPS, Chipotle, like, we're going to get a really big picture of how corporate America is doing, wages, cost pressures, outlook. It's going to be a big week in terms of earnings.
I mean, I think, go ahead.
No, I was going to say, what's the key word that you're listening for?
Efficiency.
Efficiency.
I think the key word truly is efficiency. I mean, talking about how these companies are controlling costs, talking about how they're pulling back spending. I'm going to be listening for what types of investments are they going to be making? Are they pulling back on some of those investments?
I do think it's interesting that when you look at some of the earnings that we've gotten so far, some of the things that have been an upside catalyst has been commentary about CapEx and certain types of spending. And I know it's only a couple of companies that we've gotten that have really had a chance to discuss that, but we're going to hear a lot more about that, or at least we're going to want to hear a lot more about that from a lot of the companies that are reporting next week. So it'll be interesting. That's what I'll be looking for to see longer term, whether there is sort of a tailwind of CapEx coming.
Yeah, and especially what kind of forecast they're willing to make. It's a stretch to even say anything going into next year, right? So how much are consumers actually really willing to extend themselves at this point? It's a big question mark.
Do you know what the best performing stock is in the S&P 500 this week?
Wasn't it like a trucking company or something?
VF Corp.
Oh, VF Corp. Yeah, you're right.
Yeah, and then you got Solar Edge at the bottom of the pack.
Yeah.
Get your rest, everybody. It's going to be a busy week next week.
Are you working a full week next week?
What do you think?
I think I am.
What do I think?
Yeah, I think I am. Check my calendar.
Out here, Scarlet.
Yeah.
Tim's here on a Friday. What happened?
First one in a long time.
That's the one who's here. All right. Looking forward to that bowling party. All right. That's a wrap, guys. Have a good and
Are
safe.
we committed to that?
Yes. With the shoes and the shirts.
Definitely.
We got viewers and listeners who are going to commit us to it. All right. That's
They're
a wrap.
invited too.
Thank you.
Yeah.
Looking forward to it and beating your pants off. All right. That's a wrap. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. Folks, we will see you on Monday.
And a lot more coverage coming up here on Bloomberg Television. The close isn't over just yet. Rock Nation, JP Morgan Chase teaming up to promote financial wellness and money management. We're actually going to talk to the head of community banking and development over at Chase. That conversation coming up in just a second. This is The Close on Bloomberg. Wrapping up another wild week in financial markets. The S&P 500 ending the day down, ending the week down as well. But more importantly, you take a look at the yellow line behind me on the screen. That is the 200-day moving average for the S&P 500. A level that the S&P closed below today. First time that that's happened going back to March here. Typically, that ends up being a harbinger for worse things to come. Now, whether that ends up being just an anomaly that gets sorted out over the next few days and weeks remains to be seen. But keep in mind, on a weekly basis, you saw the Dow Transports also take it on the chin. All of the big cyclical stocks as well in the Russell 2000 and in some of those other key industries that really are kind of the heart of our economy, all lower on the day and on the week. Take a look at the Magnificent Seven. On a weekly basis, 5 percentage point decline. So no help from those names. In fact, Apple down for a sixth straight day, one of its longest losing streaks in a couple of years. Meanwhile, the safety trade is on. The gravitation to the dollar, a gravitation to treasuries, and of course, a gravitation to gold, up 2% on the week. And WTI crude, which at one point on the day was above $90 a barrel, closed lower on the day but higher on the week for a second straight week because of the tensions in the Middle East. That, of course, will be a big part of the market story next week, but so too will earnings season. More than 160 S&P 500 companies scheduled to report, including some of the biggest and most consequential ones. That includes UPS. It includes an Exxon Mobil, Meta, Boeing, Amazon, Microsoft, Alphabet, and quite a few others. We're going to get a nice cross-section, not only of this market, but of the economy as a whole. It'll be interesting, Scarlet, to see not only how well those companies held up in the third quarter, but just how bullish of a forecast they can give investors for 4Q and beyond.
Well said. And of course, we will have all those earnings when they report, when they cross, all of next week. You'll want to keep it here on The Close. Now, let's move to the intersection of finance and education, because ever since it began enrolling students in the fall of 2021, the Rock Nation School of Music, Sports, and Entertainment at Long Island University has pledged to take a unique and culturally rich approach to higher education. The school's newest initiative is to team up with JP Morgan Chase and offer a 3-credit course on financial literacy. Let's welcome now Diedra Porché. She is Managing Director and Head of Community Banking and Development at Chase. Diedra, thank you so much for joining us today.
Thank you so much for having me.
So I'm guessing that this tie-up with Roc Nation was months, if not years in the making, which means that the economic and market backdrop has probably changed quite a bit since you first began collaborating. What impact did that have on the format and the content of this first ever financial health course?
Well, we really have just stayed the course. We realized when we sat down with the team that we had a shared focus and interest in really helping students develop good money habits. So we're excited. This $350,000 grant will help students be able to persist in their education and attend school tuition-free for an entire year. So we're excited about that.
And good money habits is timeless, whether the economic cycle is up or down. You talk about the funding that Chase is providing, $350,000 in support through scholarships and grants. How else is Chase lending its expertise? Will Jamie Dimon be a guest lecturer, for instance?
Well, we definitely are going to have a number of exciting guests. For example, we'll have Victor Cruz, who is a favorite New York Giant athlete, as well as Chase Griffin, the UCLA quarterback, who helps students understand what he's doing, for example, with NIL money and how to be a great entrepreneur. So we're combining really great coursework on helping kids develop good money habits, along with information around entrepreneurship, home ownership. So just a great coursework for students to matriculate.
I'm curious, Diedra, I mean, when we talk about what these kids are going to be taught, and the idea that financial literacy, financial know-how has evolved quite a bit, at least from when I was a kid. And we should just point out, when I was a kid, they barely even taught you any of this stuff. You just kind of had to learn it on your own once you got to be an adult. But talk to us a little bit about the nuances of the current economy and the types of things these kids have to know that maybe the previous generations didn't necessarily have to grapple with.
Yeah, absolutely. And so first, let me just say, good money habits are important at any age. And what we feel is really important, a lot of kids today are learning about entrepreneurship. They are learning via social media about ways to invest. But it still comes back to a core of good money habits. And it's never too early to teach those money habits. So we're excited that this is a 16-week course where we'll start with the basics to make sure that there are good fundamental habits being formed. And then from there, we will bring in speakers, guest speakers in finance, as well as in entertainment. What I'm excited about is that we're bringing the full force of JP Morgan Chase to this initiative. So we're advancing Black Pathways, community banking, our sports and entertainment, all of our divisions to really help ensure that students are getting a full breadth of a good financial foundation.
Is this just sort of a one-off, Diedra? I mean, are you going to expand this program elsewhere?
Well, what we're excited about is we're going to go the full year with this coursework. And it's important to us that we get feedback from students on what's working, what would they like to see more of. But let me just say, we really feel like we've built something that's best in class, and we would be really excited to extend this to other programs.
So as you extend it to other programs, I'm curious about the focus on the college level. Is there plans, or what is the thinking around maybe starting at high school? Because as you said, these good money habits, it's never too early to start.
Absolutely. And what is also exciting is we intend to offer programming outside of the Roc Nation School and invite folks into our Chase Community Center in Harlem to expand their opportunity to have even more education around finances. And by the way, we currently offer with our community managers financial education in our community centers, and we focus on educating students of any age. We have coursework for K through 12, for high school and college. It's a great way for them to learn money habits that they can relate to at any age.
I am curious, Diedra, there's been a lot of discussions here about the role of community banking and, more importantly, just the diminishment of smaller community banks. And I know some of the bigger banks, including JP Morgan Chase, have tried to step in to fill that void. But as I'm sure you know, a bank of JP Morgan's size can only do so much. There is a role that community banks played precisely because of their smaller size. is here. How do you see that evolving over the years? Do you think we're just in a new world where we're just going to have to deal with mega banks and the community banks that sort of supported these communities for so many years, that's over?
So I won't speak for other organizations, but what I will say is it takes banks of all size and scope to engage in communities. And I'm excited that this work that we are doing, we want to see all other institutions and banks of all size be engaged in. I think it's important that all of us play a role in educating our communities, and I don't think that'll ever change.
Well said. And I wish my son could take this course. It sounds like something that he could need. And Romaine, what about your son?
Yeah.
All of them. Good candidates. Diedra, thank you so much. Diedra Porché is Managing Director and Head of Community Banking and Development at Chase. Now, speaking of JP Morgan Chase, the bank is adding more fully remote positions. It says it's hiring dozens of virtual call center workers in Baltimore after finding success with a similar effort in Detroit. Jamie Dimon, the CEO, of course, Romaine, is known for being pretty outspoken on wanting people back in the office, but he did tell shareholders last year that he believes about 10% of the firm's workforce will be fully remote.
Yeah, and it seems like some of these are like call center type of jobs and things like that. There are a lot of support jobs that we know don't necessarily require, particularly with the technology we have today, don't necessarily require someone to be in a formal office environment. I guess it's really just a matter of the will of the company and, more importantly, how they can structure that so they get that professional feel to something. Because I don't know about you, but I've been on calls with people at certain companies from time to time, and you can hear television and children and dogs barking in the background, which is always kind of a little jarring. But if they can sort that out, sure, why not?
Is this going to sound terrible that I'm just glad to hear that they're hiring people in the U.S. for these virtual call centers? Because
no,
oftentimes
that's not terrible.
You call, and I know I'm talking to someone in India or the Philippines, and what I really want is to be able to explain things in shorthand and not have to over-explain it.
Well, don't worry, Scarlet Food, because in time it won't be people from the Philippines or India.
Yeah,
or
that's
even
true.
the US.
I'm just talking to
It'll
the
be
equivalent
AI
Siri.
bots. It'll be AI bots that won't be able to actually answer your question. But I'm sure it'll be a nice chat.
We'll just be talking in circles at that point.
Yeah, wonderful. I'm looking forward to the AI revolution. A lot more coverage coming up here on the big program. We got to check in on what's going on in Washington, D.C. as the House adjourns without a Speaker of the House. We'll explain. This is Bloomberg. The House of Representatives here in the U.S. has been without a speaker for more than 2 weeks since Kevin McCarthy was ousted earlier this month. Steve Scalise threw his hat into the ring, and, well, he didn't make it. Jim Jordan threw his hat into the ring, and after 3 rounds of voting, he didn't make it. And now the House is adjourned for the weekend. They plan to come back next week and, well, try to sort out exactly who is going to be the next Speaker of the House. Kayleigh Lyons joining us right now from Washington. And Kayleigh, a long line of people seem to be crossing the Bloomberg terminal right now saying that they're throwing their hat into the ring for what could potentially be another vote on Tuesday of next week. Who do we know has formally entered this race, or at least said that they plan to enter this race?
Well, Romaine, some of these names will be more familiar than others. Republican Congressman from Oklahoma, Kevin Hern, who was in the mix originally along with Scalise and Jordan, has said he's going to run. Others as well, including Austin Scott, who also had been running against Jim Jordan at one point about a week ago. Then you have the likes of Jack Bergman, Pete Sessions. Other names that may be more familiar as well include Tom Emmer, who is a longtime member of House leadership. He is the majority whip. He knows how to count votes, which really has been a struggle throughout this entire process. And he seems to be the individual that former Speaker Kevin McCarthy is really throwing his support behind at this point. McCarthy actually just putting out a statement saying Emmer is the right person for the job. He can unite the conference. He understands the dynamics of the conference. But of course, it will be up next week to the conference. On Monday evening, they'll have the candidate forum where they will hear from these individuals and anyone else who decides they want to run over the weekend. And then what we expect is the conference will then have a vote Tuesday morning, and potentially later Tuesday we could see something go to the floor. But of course, that's a big if in this House of Representatives.
Oh, yeah, so many different variations. What about the main figures in this drama thus far? Kevin McCarthy, Steve Scalise, Jim Jordan, Patrick McHenry. Could any of those guys come in and make a run for it again?
It's not out of the question, Scarlet, but at this point, it doesn't seem like any of them are eager to do that. Steve Scalise and Jim Jordan right now don't seem like they want anything to do with it. And as I said, Kevin McCarthy has just suggested Tom Emmer should be the man for the job. Patrick McHenry is a bit of a different question, as he is already serving in this acting Speaker pro tem role in the House. Republicans pretty much resoundingly rejected yesterday the idea of expanding his powers in any way in the interim. And he, too, has suggested that he doesn't want the job, that he doesn't really want to exercise more power unless it is given to him specifically. So it doesn't seem like he is one in the mix either. It might be someone that is more relatively unknown, knowing that any one individual has to get to 217 votes. And a lot of these more popular people or well-known people come with a lot of baggage that may make some members not be so for them.
Dumb question here, Kaylee. What are the Democrats doing? Because the last votes, in all seriousness, you talk about the 217. Hakeem Jeffries, of course, who is the minority leader in the House, has gotten more than 200 votes in at least a couple of these rounds here. I know that doesn't reach 217, and it's unlikely he would ever get there unless a bunch of Republicans decide to vote for him. But are they just kind of sitting back and laughing at this? What?
Democrats were literally laughing in the House chamber today in that third vote when they were trying to elect Jim Jordan to the Speaker's gavel, Romaine. Hakeem Jeffries, the Democratic leader, has suggested that Democrats are open to working with Republicans in a bipartisan manner, trying to maybe form some kind of coalition government. But the thing is, Democrats would ask for something in exchange is the idea. There would be some sort of concession that would have to be made, and Republicans aren't really eager to do that.
Yeah, right. Compromise, Kelly Lyons. Kelly Lyons down in Washington covering this for us better than anyone else. Stick with us when we come back after the break. A focus on the credit card sector and American Express on the back of its earnings. This is Bloomberg. A global sell-off in financial markets for the day and on the week, from Asia to Europe and, of course, right here in the U.S. The S&P 500 was all the focus today, with the breach below that 200-day moving average for the first time going back to March of this year. A 1% decline there, and similar declines in some of the other major indices. One of the few bright spots on the day, believe it or not, was actually Dow Transports, which only finished in the green by about 0.1% or so, largely on the back of somewhat encouraging news that we're getting out of the railroads and the truckers, believe it or not. So the old economy showing that it has a little bit of life, even if the new economy isn't, with all of those magnificent 7 stocks falling on the day and on the week as well. The yield story, of course, was a big part of the story for the week, and that will carry over on to next Monday and beyond as the Fed goes into a quiet period, leaving the market to its own devices for the next 11 days or so. A market, of course, that pushed yields higher on the week by about 29 basis points on that benchmark 10-year Treasury, pushing the VIX back above 20, and we saw a lot of volatility this week, Scarlet, in the energy space as well on the back of those geopolitical concerns.
And we take a break for 2 days, and we begin all over again next week with more corporate earnings, especially from those big tech names. Now, in terms of corporate earnings, American Express did publish its latest results today, and it reported record third quarter profit and revenue. The CEO saying, quote, "The investments we have made in our value propositions are driving brand relevance across generations. Millennial and Gen Z consumers continue to be the fastest growing portion of our card member base." Joining us now with more is Bloomberg's Abigail Doolittle. Abigail.
Well, what makes it so interesting, Scarlet, is that they did put up that record profit and showing strong demand for their premium products. And yet, take a look at the stock on the day, down 5.4%, the worst day in more than a year, the worst day since June 16th of 2022. So investors really not so pleased with the results beneath the surface, weighing on the space overall. And the main thing that traders and analysts and investors seem to be worried about is that network volumes missed the number on slowing growth. So profits might have been at a record, but the revenue mix not quite what some analysts had wanted it to be. Again, growth for the overall volume slowing. One thing that did help out, though, is net interest income up $3.4 billion, up 34% year over year. They issued fewer than 3 million new cards, so some folks might have been a little bit disappointed by that. They are looking for a big advertising or marketing spend next year, or excuse me, I should say in this current quarter. Then some other analysts, they said that it was a solid quarter and that because of the net interest income, that the revenue mix, that it offset those slowing volumes. So there's different ways of looking at it. But overall, because the stock was down so much, it seems as though investors are a little bit disappointed. And on the financials, it's interesting. Over the last 30 days or so, Romaine, you can see some of the big banks helping out the S&P 500 financials. And then more recently with American Express and some of the regionals that may be in this index weighing on it. Net on the year, down right about this amount, down about 6%, which given the fact that we had the Silicon Valley and the regional banking collapse earlier this year, kind of amazing.
Yeah, interesting moves that we saw today, particularly in American Express. Of course, those shares having their worst day going back to June of last year. And we talk about this idea here of how do you keep those American Express customers there. Folks, of course, who do have to pay some relatively hefty fees. And the idea is that, well, you get some sort of rewards in return. But a big series of changes by a lot of its partners, including Delta Airlines, has really raised a lot of questions among cardholders as to whether it's still worth it. Eric Rosen is joining us right now. He's the director of travel content over at The Point Sky. And Eric, I mean, just help me out on this here, because I don't know if my eyes are deceiving me, but as somebody who has a couple of these rewards cards, it seems like the rewards have gotten skimpier and skimpier and skimpier, yet the annual fees they charge me seem to have gotten fatter and fatter and fatter.
Well, no one can blame you for feeling that way, especially this week. Amex and Hilton actually just increased the annual fees on two of their most popular hotel credit cards, the Hilton Honors Surpass and the Hilton Honors Aspire. The Hilton Honors Surpass went from $95 a year to $150 a year. That's over a 50% increase. And then the Aspire went from $450 a year to $550 a year. And I think a lot of people are probably saying to themselves, what am I paying $550 a year for a credit card? Well, Amex and Hilton are hoping that you'll stick with the card because they've added some new benefits, including a new airline fee credit that gets you up to $200 back on airfare each year. That replaces a formerly hard-to-use airline annual fee credit. So they really are trying to tailor the perks in order to entice cardholders not only to hang on to the cards that they do have already despite rising prices, but to sign new people up.
But that tailoring is the issue here. I mean, I guess if you do it right, then great, but I feel like a lot of them have got it wrong. And let's focus on Delta, because this obviously seemed to be the more public misstep here, where they actually had to walk it back here. I mean, it wasn't just saying we're tailoring this to make it a little bit more efficient. It was kind of taking away things that people felt they had already been promised.
Absolutely. Think about it. If you'd signed up for a very expensive Delta Reserve Amex card expecting unlimited visits to Delta lounges per year, only to be told that your number of visits per year was decreasing to just 10, and that each time you stepped in a lounge, even if it was the same day of travel, stopping in Atlanta and then in Los Angeles on the way somewhere, that those counted as 2 visits. Well, that wouldn't be worth hanging on to a card that's over $500 a year for. Delta in particular also made a massive overhaul to its rewards program. The credit cards are going to play a larger part in that in terms of spending counting towards your elite status. But as you mentioned, they were forced to roll back some of it due to public outcry, due to the higher spending requirements that they're going to have to meet certain levels. So they at least lowered some of those thresholds for next year. They're easing people into it. And if you do have one of the Delta credit cards, you're going to be gifted with a certain amount of status dollars, basically, towards your status next year already. So that might be a reason to hang on to your card just for a little while longer.
You know, as Romaine was talking about all these things where they're removing perks, they're making it more difficult for you to redeem your points. When there are these abrupt changes, who's deciding this? Is it the airline, is it Delta, or is it the bank behind it? I'm just trying to understand who I should get outraged at.
Well, probably both of them is a good thing. Spread it around as much as you want, I would say. You know, Delta and Amex are such close partners. That partnership is, decades in the making. It's been one of the most profitable in the travel industry. And so when Delta aims to make changes to its program that are as monumental as the ones we saw them announce back in September, and then the outcry from both their loyalty program members and those who have their credit cards and the overlap between them, you can bet Amex probably had something to say to the airline about, making sure that the perks it was still able to offer its cardholders still gave them enough value to hang on to it, because those annual fees really add to the bottom line for the credit card issuers.
Right, gotcha. Okay, I have a question for you as well, because once upon a time, Starwood's rewards program was the stuff of legend, right? Great perks created die-hard loyalty among travelers, and then Marriott bought Starwood and watered down the program, and that caused all kinds of consternation. What has the credit card industry and the airlines and the hotel companies learned from that episode?
I think, unfortunately, they've learned that they can pretty much make the changes that they want to their programs. I think that the instance with Delta from this past month shows, though, that they do listen to customers and that when they hear enough outcry, they do roll back some of those less popular changes. It's important to remember that loyalty is a two-way street. People will vote with their dollars and their spending. And so if a program, hotel, or airline changes itself too much or makes too many negative changes, they can expect a backlash and it to hurt their bottom line. Unfortunately, you're talking my language. Starwood back in the day was a fantastic program. Marriott still has a bunch of wonderful ways that you can maximize it, but you do have to work a little harder, it feels like.
There is a sort of a broader question here, Eric, about just economic conditions. I mean, some of these changes are being made, obviously, because the companies aren't making enough money, at least what they think is enough, based on that current structure here. And some of that has to do with the fact that, let's face it, a lot of us are spending less, or maybe we're not taking as many trips, or not, patronizing all these businesses in the same way in the past here. What type of trends are you seeing in that space, particularly when we know that a certain cohort of our economy right now is kind of sitting on a pretty big balance right now of unpaid credit card debt?
Yes, that's the issue, right? In August, I believe it was announced that credit card debt in the U.S. Topped $1 trillion for the first time and is only trending upwards. A TransUnion report from May also noted that the average credit card debt was about nearly $6,000 per borrower, and there are now more than 70 million credit card accounts, more than before the pandemic. So more and more people are going further and further into debt. As the Fed raises interest rates, that obviously affects APRs, so people are now paying more just to keep up with the debt that they're accruing. And more people are relying on their credit cards actually to go to meet their needs from paycheck to paycheck. And that's affecting even high earners like those who earn more than $150,000 per year. So all of it seems to be a little bit of a recipe for more and more debt, unfortunately. And rewards can't exactly make up for that because you're just paying so much to keep that account active that the rewards you earn really can't reap the value to make up for that.
All right, Eric, great to catch up with you here. Eric Rosen, he's the director of travel content over at The Points Guide. Coming up here, Fed Chair Jay Powell says, well, the FOMC takes fiscal policy as it comes. But former Treasury Secretary Larry Summers, guess what? He has a contrarian opinion. We're going to hear it coming up next. This is Bloomberg. Back to the close. It's time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Wesson, joins us every day here ahead of the big show, which airs right around 6 p.m. New York time. And you actually had a chance to sit down with former Treasury Secretary Larry Summers. Yeah. We should point out you also had a chance this week to sit down with Fed Chair Jay Powell. And I'm told Summers had some thoughts on what Powell had to say.
Exactly. We thought we had these two things. We should put them together. And so we asked Larry what he thought about what we heard from Chair Jay Powell. And by and large, he thought there weren't a lot of issues. But he did take issue with one thing in particular, and that is the problem of the U.S. deficit.
David, congratulations to you on a really interesting interview from which we all learned a lot. Look, I think it's pretty clear that markets have decided that they're pricing forward rates substantially higher than they were not very long ago. I didn't find anything to strongly disagree with in what Chairman Powell said, but there was a big Newfoundland of a dog that wasn't barking as he was speaking, and that's everything about the federal fiscal situation. That matters two ways. If there's more debt and much bigger deficits, that means more demand in the economy, and that raises the neutral rate now and raises even more the prospective neutral rate in the future. That's one important link. The other important link is that when you're trying to sell huge amounts of long-term debt because you have very big deficits, its price goes down, and that means higher long-term yields, a rising term premium. And I think you've got both of those phenomena going on, and realization that the neutral rate's likely to be higher because of fiscal policy and the supply absorption aspect. And I understand that the Fed's job is not to get involved in fiscal policy, But I think over time, the Fed is going to have to, as the monetary authority of the country, going to have to engage on some of these questions about Treasury debt, especially given the magnitude of its own balance sheet and the magnitude of the losses that acting as the agent of the Treasury and taxpayers, the very substantial losses that have been taken in a mark-to-market sense on the Fed's balance sheet. So those fiscal issues have to be at the center, it seems to me, of a discussion of interest rate issues.
So pick up on exactly what that means for the Fed, because Jay Powell didn't deny that, although he said there are a lot of factors. He thinks that's just one factor going into what's going on with the 25-year yield, for example, or 30-year yield right now. He said it's too complicated, he doesn't really know. But he said we have to take that as it is. It doesn't change our policy. If you were exactly right, and I assume you are, how does it change the Fed's policy, monetary policy right now?
Well, I think there are two separate parts of it. Insofar as the neutral rate is being pushed up by higher fiscal deficits, that's a thing that means the Fed has to raise the actual rate in order to keep the same degree of balance between the accelerator and the brakes. Insofar as the interest rate is going up because of some kind of term premium, and that's important, that's restraint that's being applied to the economy, that's the brake, and it might substitute for a brake the Fed would otherwise have to provide. So it's not enough for the Fed to recognize that rates are going up. It has to implicitly be forming a view as to what the cause is. And I don't think that's analytically easy at this point. And it's sort of the first rule of minefields to step gingerly. And I think the Fed's doing that in the signals they're sending that they're not likely to move in November and that December is uncertain. And I think that's appropriate. I think there was kind of a failure in markets. I've kind of been struck over the last several years by markets being a bit myopic beyond what's right in front of them. They were that way with respect to inflation. It seemed to me they were that way with respect to low, long rates in the early summer. And I think markets have to sort of recognize that the fiscal picture is going to be significantly complicating for some time to come.
On the question of the neutral rate, we talk about it a lot. I understand it's not directly observable, which is a challenge. But one of the things we talked about with Jay Powell was that back in August of 2020, he said that he thought that that neutral rate had come down from something like 2.5 to 1.8. This week, what he said when asked was, well, it doesn't move that much. He thinks it's somewhere around 2 or a little under 2. Does that sound right to you?
I'm not sure whether that's a reference to the nominal rate or the real neutral interest rate, David. My view would be that the real neutral rate is probably in excess of 1.5 percentage points, given the magnitude of deficits, and that inflation is probably going to tend, given everything that's going on, to be greater than 2. So I would think of the neutral rate that the Fed has been calling 2.5, inflation plus real, as probably being more in the 3.5 to 4 range right now.
And Larry, what do you make of the question about whether some of the turmoil in the bond market is really a potential risk for the financial system? We're seeing a lot of volatility, and of course the rates on the long end have gone up a lot. At the same time, the rates on the short end, as you know well, have not moved much.
Well, I think that is because there's a set of questions about the absorption of all this long-term debt. The Treasury's selling massively. The Fed is selling substantially. The Fed, through its regulatory policies, is appropriately telling banks not to buy. Foreign reserve holders, for various reasons, are wanting less U.S. long duration debt. So you have a supply-demand imbalance, and that's something that makes markets move. I think it is something that has to be watched very closely, and I think the Fed has an obligation to be ready to assure the liquidity and the functioning of the Treasury market. But as is always true, David, there's a difference between a volatile market in response to new information, when there's a lot of new information coming, and some of it may not be good. That's one thing. It's a quite different thing when you have a non-volatile, when you have an illiquid and not functioning market. I haven't seen evidence yet that that's where the Treasury market is, but certainly that's something that the Fed, and particularly its outpost in New York, needs to be watching closely.
That was special contributor Larry Summers of Harvard. And one of the things that struck me, Romaine, is that even as we talk about this issue with the economy, what we don't talk with either Jay Powell or Larry Summers about is the political aspect of it. We don't have a Speaker of the House, and if we really have a substantial debt problem addressing that, we don't have the political leadership to address it.
It's a good point, too. And I mean, it kind of puts the Fed in a bind. I understand his argument here that the Fed needs to adjust to account for these things, but you know, for a Fed that keeps saying it's data dependent, how do you adjust for things that I can't really be reflected in the data?
And there's further question of how much investors have to adjust, the possibility of really higher rates for a longer time for all these factors. To my addition to all of that from Jay Powell, we're also going to talk to Jan Eberle of the Kellogg School of Management, Chris Ailman of CalSTRS, and Dan Senor. He's the author of Startup Nation. That's on Wall Street Week tonight at 6 p.m. Eastern Time.
A nice lineup here. Be sure to stick around for that at 6 p.m. And David joins us every day on the close for his Wall Street Week daily segment. Coming up after the break, Scarlet and I are going to set you up for what to watch next week. This is Bloomberg. Capping a wild week here, Scarlet, and I think next week could actually be even wilder, except it's not going to be about the macro. It's going to be about earnings and, of course, a lot of those big tech names reporting.
Yeah, Microsoft, Alphabet, Meta, Amazon. I think after next week, almost all of the Magnificent Seven will have reported, except for Apple, which is in 2 weeks, and NVIDIA, which is on its own in late November.
Yeah, they're out on their own little island. And then once we get past the big tech, we get into some of the other stocks that I think really do reflect the breadth of our economy.
Yeah, big oil. Chevron and Exxon will be reporting. Of course, Mattel will take a bit of a victory lap with Barbie because it was in the third quarter. Remember that? Ford and GM will get an update on the strikes and what it means for them. I think that's going to dominate the theme.
Yeah, and we should point out that we were getting headlines just a little while ago from Sean Fain, United Auto Workers. Some progress, it felt like, this week. I mean, we got some interesting commentary out of both him as well as the companies that at least they're still talking. Yeah, they're talking. They're talking. They haven't quite gotten there. We're going to get actually a rate decision next week because we kept talking about the Fed going in the quiet period. The ECB has a decision.
And the ECB, of course, raised rates last time. They only have one mandate, which is to manage inflation, unlike the Fed, which has to factor in full employment as well.
We're going to get a lot of economic data that the Fed can chew on, including PMIs and new home sales.
Is anyone buying a home? I mean, rates are way too
Scarlet,
high.
We had this conversation early. No,
yeah.
I mean, I guess if you have cash and and somebody's willing to sell, I guess you're going to get that. We get an update on GDP. We get jobless claims, durable goods, and then on Friday, the one I'm interested in, we do get that new fresh PCE and personal consumption data.
And that's the one that the Fed looks at in terms of spending and inflation. So that'll be critical.
All right, Scarlet, you got big plans to spend and support the economy this weekend?
Always. I overspend.
All right, we'll be back next week. Please, thank you for watching us. Balance of Power is coming up next. This is Bloomberg.